range as a target. I will note that's reinforced by the more recent trends. It's reinforced by people moving back into dollar funding, which boosts the value of the euro, so cutting short positions in the euro as a result. But I will also tell you where our optimistic case on the euro will end, because we've already started to hear a few murmurs and noises around the French election. So later in the year, sometime in the second half of the year, I think that will start to become a market theme that will be a prime candidate to top out the euro-dollar is in.
Ibrahim, always good to catch up with you, sir. Thanks for being with us. Ibrahim Ragbari there, Citi Global Head of FX Analysis. You'll like this tweet, Tom. I know you already like this tweet. It comes from Sven Henrik, the Northman trader, out on Twitter, who says, as long as you don't need money to pay for living expenses, housing, food, college or medical expenses, there is absolutely no sign of inflation.
Yep.
That seems to be the take for a lot of people out there too, Tom.
Long ago and far away, when Lawrence Kudlow made his name screaming about core inflation, John, I happen to be in that camp. I think that it's not that there's been damage of this, but it has delinked the academics from society to partition inflation out, because that's not what happens at the Abramowitz house.
Do you think we could get Mr. Carney to maybe comment on this a little bit later?
I believe we can. We will speak to the governor about climate, about Biden, Xi, and then John, I know you've got some good questions on the monetary path forward.
Only John, though.
Yeah, you know, I don't. I just want to ask him to get vaccinated.
I think he's excluding himself, Lisa.
It's fine. I'm all for it. I was vaccinated yesterday.
In the next hour,
I'm going to ask him about the
looking forward to the
Toronto
conversation
Maple Leafs.
with Mark Carney, the former Bank of England governor.
They haven't won since '67.
Inter Milan confirming the club no longer.
Yeah, well, the Maple Leafs winning is transitory.
Plan.
It's just talking his own
How long
show.
have we worked together, Tom? Together being an interesting word.
I was about to say, define together.
Futures down a point on the S&P 500, 41.25.
Snooze fest.
It's Bloomberg.
John, it's a snooze fest before the ECB meeting.
With the First Word News, I'm Ritika Gupta. In Minneapolis, former police officer Derek Chauvin has spent his first night in jail. A jury convicted Chauvin of second-degree murder and other charges for killing a black man, George Floyd, when he kneeled on his neck for more than 9 minutes. Chauvin will be sentenced in about 8 weeks. He could face decades in prison. White House officials have told supporters they will pledge to reduce U.S. greenhouse gas emissions by at least half by the end of the decade. That's an almost doubling of the nation's earlier commitment. The goals being discussed ahead of this week's International Climate Summit. That rebel soccer league in Europe has fallen apart just days after its launch. The chairman of Italy's Juventus club says the project will no longer go ahead. The collapse was inevitable after all 6 English teams involved pulled out of the so-called Super League. The idea was blasted by fans, politicians, and soccer authorities. And shares of Netflix lower sharply pre-market. The streaming service added far fewer newer customers than Wall Street had expected in the first quarter. It even missed its own forecast by millions of subscribers. Plus, Netflix says the current quarter will be more challenging. A lack of new shows may be contributing to this slump. All this comes after record growth in 2020 that Netflix said was due to the pandemic. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We still have work to do. We still must reform the system. This bill is part of George Floyd's legacy. The President and I will continue to urge the Senate to pass this legislation, not as a panacea for every problem, but as a start.
Accountability, not justice yet. That seems to be the takeaway for many people in the United States of America. That was Kamala Harris there, the US Vice President. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here is your Wednesday morning price action, shaping up as follows on the S&P 500 after 2 straight days of losses. We are down another 2 points on the S&P 500. Into the bond market we go with yields higher by about a basis point or so on a 10-year to 157.14. Euro dollar coming in just a little bit. The euro negative 0.2%. Euro dollar 120. And crude down a little more than 1 full percentage point as well. Just a break of 62 here, Tom, on WTI at 61.97.
Watching the markets churn here with more earnings coming out. We'll have much more of that with you. Governor Carney joining us later on climate change and, of course, monetary policy. Right now, we digress. And for our international audience particularly, we give you a bit of a window into the distance from Minneapolis to Washington. Emily Wilkins joins us, our Bloomberg government reporter. Emily, I thought that Peter Cahill, the judge yesterday, was absolutely extraordinary when I look back on other cases where a nation stops to listen to the verdict. That's happened a few times in my life. And of course, we all remember the moment of OJ and that years and years ago. How does Washington move forward? The president and the vice president made appropriate comments yesterday, but how do the politics of Washington move forward after this verdict?
Well, Tom, there are a lot of lawmakers in D.C., particularly Democrats, particularly progressives, who see the verdict yesterday as just one step in more that needs to be done. You heard progressive Congresswoman Ocasio-Cortez come out and say that, a verdict, it's not the same as policy change. Policy change is needed. You saw the Democrat-led House pass a bill on police reform that would include a ban on chokeholds, would make it easier for individuals to sue police. But of course, like many other pieces of legislation, that bill is now stalled in the Senate, where they're trying to find a way to get 10 Republican senators to vote for it. And the outlook at this point isn't particularly good on that.
Well, you lay out beautifully the divides of this nation as witnessed by the House and the Senate as well. Is this an issue that is germane to the elections of 2022, or is it a moment of national pain, national crisis that we move on from?
I mean, I think it's a little bit of both, right? I mean, after the killing of George Floyd, you saw individuals from across the ideological spectrum come out and condemn this, condemn what happened, say that there needed to be justice in that situation. However, when you get down to the brass tacks, it's right back to partisan politics. And I think you mentioned the midterms, you mentioned 2022. I think Democrats are very aware that Black voters handed them a victory in 2020, particularly in Georgia, where they gave them those 2 Senate seats needed for Democrats to have that very, very thin majority, but still majority in the U.S. Senate.
Emily, does this verdict energize or de-energize the defund the police movement?
I absolutely think, I mean, to be careful here, I would say that it energizes Democrats and progressives. I think a number of them, particularly lawmakers, would be very concerned about saying that they are part of the defund the police movement. I think you've seen Democrats try to sort of walk this fine line where they don't want to be accused of defunding the police, but at the same point, they want to show that they are strong on getting police reforms, on ensuring things like what we saw with George Floyd do not happen again, and that we do see verdicts like we saw yesterday. So I think they're trying to move away from the name defund the police while still trying to move forward with policies and actions that show that they are serious about this issue.
With President Biden calling other lawmakers to honor George Floyd with a police reform bill, but talking about the Biden agenda yesterday, he also came out with some pretty ambitious green policies, carbon emissions reductions policies for the United States, much more aggressive than what we saw under President Obama. How much teeth are there? How many teeth are there to these proposals, this idea of actually some of this coming to fruition?
Yeah, I think it's definitely an ambitious plan that President Biden put forward. I think when it sort of comes down to the fine details, we're going to be looking at that upcoming infrastructure package. That's where President Biden has said that he wants to include climate change provisions and other provisions to sort of help alternative energy sources grow. But the question is exactly what's going to be in that bill and how much of an impact does it have? I think President Biden from the start has really been adamant on having climate change be a focus of his administration. I think the details that came out yesterday are in line with that. But of course, it's going to be up to Congress to see exactly how much of change can be made here.
Yeah, but is this what we're going to get for the next X number of years, where there's a lot of, presidential proposing, but an inability for the legislature to dispose of it?
Well, it depends. I mean, if you look at the Trump administration, there wasn't that same push on climate change and on the energy that we're seeing from President Biden. And so I think this is another thing that you're seeing with President Biden here. He's having to sort of turn the tide after the Trump administration by coming back to all of these countries and saying, look, we know the U.S. was pretty absent from this space in the last 4 years. We know that we pulled out of the Paris Climate Accords, but now we're back and we're stronger than ever. And he's really trying to convince other countries to take the U.S. seriously in this arena and to work with us and continue to be a part of our initiatives going forward.
Emily, good to catch up. Emily Wilkins there of Bloomberg Government. Tom, I think many people taking this administration seriously on this particular topic. I thought it was interesting to hear from Secretary Blinken in the last couple of days, who said we will not allow other countries, though, to use this issue as a bargaining chip to excuse bad behavior elsewhere. I think that was directed at one specific country and one specific government, the Chinese Communist Party. But that's where the conversation has been the last couple of months, that maybe the Chinese and the Chinese Communist Party would try to use climate change and climate issues as a bargaining chip to excuse other issues that the United States has been pretty ferocious about.
I'll let you, John, gauge the cynicism here. If you're just waking up across America, Mr. Xi will join Mr. Biden at a climate summit here. What is it, John, in 2 days or so? I think they will go through the formalities of the moment.
Something like that, Lisa. They'll agree on issues where they can agree, and this might be one of them. But that does not mean we'll move on from the other issues quickly.
Yeah.
No, and there's also an answer here to how much this agenda could spur new employment, right? I mean, that's how Biden's trying to spin this, to say we can invest in green energy and be the dominant player in the transformation around the world, and this will help the U.S. economy. How does that play with China that's trying to do the same role?
I mean, John, let me ask you this, because I think it's really important, and it's very European here. here. We blew up the Paris Agreement. Full disclosure, folks, I attended those meetings with a lot of the support of Michael Bloomberg. But John, do we need to have a new Paris Agreement, or at least a new confab, if you will, to reaffirm the pre-Trump mandate?
Yeah, I'm not in a position to answer that. I would just say that this administration and its approach around this issue is a whole lot more sincere in the eyes of many people around the world relative to what we saw maybe in the last 4 years. Is that diplomatic enough?
Well, also, Tom, you're European. You should answer this. Paris Climate Accord. Go, John. I mean, really, honestly,
no,
though.
I think that the Europeans have to provide a lot of leadership.
Well, I think Tom's right to bring up Europe. I think Europe is the problem child on so many issues right now. Germany over Russia, Germany over China too, Tom. There's so many issues that need to be worked out.
Yeah, and whether it's different than TPP, but this, to me, what they can deal with in the next 2 days is a reaffirmation of the Paris Agreement.
From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equity shaping up as follows. We're down 3-4 points and off by 0.1%. This is Bloomberg Surveillance.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Is there anything you think the Fed should be able to do to help people who are really suffering in the pandemic?
I think they need to be in the room with us as we make our decisions about monetary policy.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide. Good morning to you all, live on Bloomberg Television alongside Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. Here's the Wednesday morning price action. 2 straight days of losses across the board here on the S&P, the Nasdaq, the Russell. The small caps down by more than 3% Monday through Tuesday. We bounced back a little bit on the Russell, up 1/3 of 1%. Elsewhere, down 0.2 on the Nasdaq. The S&P 500 basically unchanged. If we switch up the board and get to the bond market, 2s, 10s, 30s shaping up as follows. Yields look like this, a little bit higher. We creep higher by a basis point or two. 157.31 on 10s, on 30s to 227, let's call it. And finally, in foreign exchange, just a quick look at euro dollar, if we can. Euro clinging on to a 120 handle on euro dollar right now, 120 flat, and down about 1/3 of 1% on the session, Tom.
Yeah, a little bit of movement there. It was just fascinating to see, and certainly Monday, Tuesday, John, didn't we see a lot of strategists line up markers to a stronger euro?
125 to 130.
Yeah.
I think they still stand by that despite what we're seeing this morning, Tom.
Yeah.
The path forward pretty clear. Vaccinations in Europe a whole lot better relative to where we were several months ago.
Yeah.
And I think that opens up a very different runway to what we had in front of us maybe at the start of the year.
You see the numbers and the death statistics as well. Europe doing better. The United Kingdom flat out leading the way. This is a joy, and it's particularly a joy in the tumult at the moment we are in this natural disaster that we're all facing. Tony Roth is at Wilmington Trust after holding court at UBS for years. For those of you internationally, Wilmington Trust is someone who manages quiet money. He does it with the philosophy of Brown University, the Sorbonne, and other academics. Tony, thrilled to have you with you. What's your philosophy on diversification? At Wilmington Trust, you have a pressure of people coming in who made it big with 5 or 6 holdings. What's your theory, your philosophy of modern diversification?
Yeah, good morning, Tom, John, and Lisa. Thanks for having me. Well, I think I would start by looking at the observation that roughly 1/3 from the perspective of a U.S. investor, 1/3 of domestic equity opportunities are in the private markets and 2/3 are in the public market space. So we have to start from the perspective of diversifying not just within public market equities, but private market opportunities. And curate really compelling opportunities within the private market space. In many cases, uncorrelated or inversely correlated to public markets, bankruptcies, distressed debt, longer-term industrial real estate holdings, those types of things. And then within the public market space, make sure that we're diversified, particularly within U.S. equities across different factors and different sectors. And we time some of those considerations, but not too aggressively. And if you have that kind of diversification, markets go up an awful lot more than they go down. Have a slight overweight to equities, and over time, you're going to come out ahead.
How do you manage the response of your clients at your trust company to the technology boom? They're not satisfied with the S&P 500 return, and maybe in the recent months they are. But as a general statement, they're all saying, why don't I own more Apple? Why don't I own more Amazon? What do you say to those people?
Well, in the context of, and look, we like the technology, those big technology platforms from a secular standpoint. We think they're going to outperform over the next 3 to 5 years. The Amazons, Googles, Microsofts, Apples. They are the, if you will, the rails of the digital economy, and the entire economy is digitizing. Having said that, we are in a classic rotation towards more cyclical, economically sensitive stocks. And even though we've had a pullback in the last few days, few weeks, even month or so on those economically sensitive stocks, we see those big technology platforms relatively underperforming for the rest of the year. And we have an historic pivot in the economy from goods to services that's going to drive those more economically sensitive stocks and sectors. And so clients want to be in those sectors if they want to outperform the S&P. They don't want to be overweight those big technology stocks. Tom, the biggest issue we have right now, which is really shaping up in a really fascinating way with respect to the technology stocks, is that we at Wilmington Trust have actually had an historic overweight to those technology stocks. Consequently, our clients, in most cases, still have an overweight. And now that we are looking at a potential doubling of the capital gains rate, we may be in a position to convince our clients to sell down some of those holdings and pay capital gains at a lower rate before those tax rates double.
Interesting. Tony Roth of Wilmington Trust, given the fact that we're seeing a pause in markets of sorts, a sort of reset as people try to chart the path ahead, I want to take a break and go to Philosophy Wednesday. This question of, on a larger scale, have we skipped the default cycle? What are the consequences of the death of a default cycle based on monetary and fiscal stimulus?
That is a really terrific question, Lisa. You know, I ask Luke Tilley, our chief economist, almost every day, Luke, where are we in the economic cycle? I'm trying to figure it out because there's a whole slew of indicators that suggest we're early cycle, that relate to the kinds of economically sensitive stocks that are going to continue to drive the market and the direction of interest rates. But then there are other indicators like the default cycle that suggest we're late cycle. We haven't had those defaults. So I don't believe that we're going to see the defaults in this cycle. And given monetary policy and the accommodation that we're seeing from fiscal policy, even with the tax hikes, which are a tightening in a sense, there's so much additional stimulus from fiscal policy overall on a net basis. I just don't think we're going to see the default cycle that we typically see, either in the private space or the public space.
And Tony,
it's not going to happen.
You're in good company. A lot of people agree with you, including the big rating agencies. Fitch just recently coming out and downgrading their forecast for the high yield default rate for 2021 to 2%, the lowest default rate going back to 2017. Yeah. The stimulus has effectively killed off the default cycle. What are the longer term consequences of that? Lower growth, lower returns, potentially more zombie companies. How do you factor that in?
Well, I do think that you're going to see more zombie companies over time. I do think that you're going to see lower returns going forward now. And spreads are so tight right now in the high yield space. On the muni side, spreads are still wider, so there's still opportunity to deploy assets into the high yield muni space, but not on the taxable space. So I do think that you're going to see a lot less opportunity for professional investors. You're going to see less volatility. But I don't think that from a growth standpoint, it's really going to be a problem for the economy. I think the economy is going to continue to move forward due to the sheer scale of the fiscal stimulus. And we're going to see GDP growth this year in the 7 to 9% range. And then we're going to settle down next year in the 3 to 3.5% range, which is not priced into the market. So when you put all that together, Lisa, while it's a really weird combination, unusual combination of considerations as to where we are in the economic cycle, I believe that the...
Okay, traders, I'm going to place an order to sell British pound. The price I'm looking to sell, 139.313. Okay, so I'm placing an order to sell short at 139.313. Okay, if you're looking to trade British pound, here is your chance. You can place an order, and then when it gets filled, I'll let you know what's going to happen and how long. But we'll see. I can't tell you definitely how long we're going to hold it. But stay with me, and we will go through from the beginning to the end through this trade. Okay? Stay safe, and I'll speak to you later.
On the bottom line by amounts that exceed the average outperform rates. So you're seeing very strong corporate earnings, and the economy is doing terrific. I mean, we had these wowza numbers, retail sales, labor market. So we're not really seeing a slowing in the economy. We're seeing a bit of a pause, if you will, in the reopening trade, because look at United Airlines. United Airlines came out and they said, hey, things aren't as great as we thought they were going to be. This is going to be a more extended reopening for us. So you're seeing a little bit of an extension or a pause in the reopening trade, but you're really not seeing a fundamental questioning of the underlying narrative. You're just sort of seeing a pause in the stock market. The question is, there's going to be a massive reopening dividend for equities. Yeah. So corporate profits up 25% year over year this quarter, 50% in the next quarter, 50%, and then in the third quarter probably 30%. How are they going to spend that reopening dividend? And I think you're going to see a tremendous amount of those assets reinvested in CapEx. And hopefully you're going to see some of it reinvested in job training and skills, because the biggest risk in our view that we have is inflation materializing because of a mismatch in the labor market. There's so many openings right now and you don't have skilled labor. So companies really need to reinvest that dividend, that windfall from reopening in skill training and re-education and vocational investment.
Tony, it's good to catch up. It's good to see you. Thanks for being with us. Tony Roth there, Wilmington Trust Chief Investment Officer, killing the default cycle. If you want to read a little bit more of this, you can on Bloomberg Opinion. Lisa Brammer's authoring that piece a little bit earlier this morning. Tom, she never told us, did she? Never told us that Lisa Brammer was authoring a Bloomberg Opinion piece a little bit earlier this morning on killing the default cycle.
I'm moonlighting a little bit in my old
Was this you
haunts.
just fessing up to saying, I've been wrong over the last 12 months? Was this like the mea culpa of the last?
She was looking around.
Is that what this piece was?
I was looking around corners. Thank
was?
you. No, I'm taking a big picture look. I'm trying to understand the low spreads and trying to understand what this means, given that the valuations seem incredibly high, things seem incredibly frothy, yet it makes sense. What are the longer-term consequences if we're not going to see an imminent crash?
John, what's so important here is Wilmington Trust is truly one of our most venerable trust companies. John, this is as close as we get to British old money. And you got a hugely optimistic cast from Mr. Roth there on what do we do out of a boom economy. And he's basically saying, look, you've got to be on board. You've got to participate as we get beyond these silly numbers we're dealing with right now.
I remember when Christian Mamani turned around to me last year, about 12 months or so ago, a little bit more than that, a little bit more than a year ago, and he said, you can stop panicking when policymakers start to panic. Boy, they panicked. And that's the story here, isn't it? That is why this default cycle was effectively eradicated before it even started, Lisa. And that's why so many bears have been so wrong about what would happen in this market.
But what are the consequences of companies that perhaps should have failed, that are inefficient,
I think you touched on it.
that aren't well run, of them surviving and continuing to try to pay down debt that was taken on during a different era while they're trying to invest?
Dynamism. A loss of dynamism, clearly. Capitalism should take the money away from the bad companies and take the money towards the good companies. And every time we have this kind of intervention, we prevent that from happening.
And there's also a question of what ends this cycle, because the more debt these companies have, the more the push to a disinflationary environment that creates lower rates, that creates more debt. Who ends this cycle?
Lisa Brammer, Tom Keene, Jonathan
fired
Farrow.
up, you know.
She's fired up. You can tell she's fired up.
You know, honestly,
I know.
it was something that I've been thinking about.
I can tell. Lawrence Sauer joining us a little bit later, Johns Hopkins Associate Professor.
I'm going to write
of
an op-ed
Emergency
piece for
Medicine.
Bloomberg Opinion.
What's your
on the
op-ed piece going to be?
On the tots.
Football.
Sanko.
Yields up by a little more than a basis point on 10s to 157.49 euro dollar.
Pro tang.
What should Harry Kane
flat.
do?
41.25 on the S&P 500. Mourinho is out of Tottenham. Tom, we barely talked about that. What a week to do it.
We've been distracted.
Good week to do it. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. Derek Chauvin will learn his fate in about 8 weeks. That's when a Minnesota judge will sentence the former police officer for the murder of a black man, George Floyd. Chauvin was videotaped whilst kneeling on Floyd's neck. The jury convicted Chauvin of second-degree murder and a number of lesser charges. He could get decades in prison. A U.S.-driven effort to reach an agreement on taxing big tech companies' overseas profits is getting bogged down. The reason is one company in particular, Amazon. The new rules would apply to any large companies that exceed certain numbers for their annual revenue and profit margin. But Amazon is a low-margin tech giant, and other countries are balking at the idea that could mean it wouldn't be covered by a tax agreement. Shares of Toshiba fell after the Japanese company said a potential $21 billion buyout offer from CVC Capital Partners has stalled. Toshiba's board had urged caution over the talks, saying they might not lead to a deal. Meanwhile, Reuters says Bain Capital is considering a bid to take Toshiba private. Apple's unveiled a faster iPad Pro with a brighter screen and 5G connectivity. That's a more powerful version of its priciest tablet aimed at workers and students returning to offices and schools. The 11-inch version of the new iPad Pro will cost $799. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
This is really an extraordinary moment, I think, in terms of thinking about cures for genetic disorders.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Big tech such as Alibaba and Tencent are no doubt national champions, but now China is stepping up oversight. Just how far will the Chinese government go on regulation? We'll explore on a Bloomberg special, Red Lines, China and Big Tech.
Once we get to around maybe 40% of the population fully vaccinated based on Israel, I think we'll start to see a decline in cases the way they did. But we've already seen benefits in terms of hospitalization because our older individuals who were taking up hospital beds, the ones who are most likely to have severe complications, and that's not happening so much anymore because how many of them have been vaccinated.
What a great effort in the United States of America. That was Dr. Ramesh Adalja there, Johns Hopkins Center for Health Security Senior Scholar.
Okay, guys, we're in. So if you decided to trade British pound, and if you placed an order, we're in, okay, at 139.313. Okay, stay with me, and I'll tell you whenever place stop loss, we always place stop on profit. So stay with me. I will tell you, I will guide you all through this trade. If you want to find out how come whenever place stop loss, we always place stop on profit, just get this strategy. It's available on company.co.uk website, and you will get all information from the strategy. Okay, stay safe, and I'll speak to you later.
Equity, our earnings, if you will, earnings season conversation of the day. Right now on the pandemic, as we heard from Dr. Adalja, Lauren Sauer joins us with Johns Hopkins, Associate Professor of Emergency Medicine. Tell me about the lower cohort, Lauren. I see the charts, but I really don't understand the vaccination rate of, say, 18 to 25 and the vaccination rate of, say, 21 out to 30. How are they doing?
Yeah, we'd like to see an uptick in the vaccination rates in those groups for sure. It's looking better and better each day as more and more of these groups get access. So, across the U.S., we saw the rates or the age limits drop. So 16 and older can start to get vaccinated across the country. I think even earlier than any of us expected, which is great. The next step is making sure that not just the people who were ready and lining up to get the vaccine are there at the mass vaccination sites and the clinics, but then, the people who are still unsure or their parents are unsure for them.
Lauren, help me with the international view and how it redounds back to America. This question came up at least 3 times yesterday. We have horrific news from the Philippines, from India. We have Tokyo and Osaka shutting down as well, and there's a number of other stories. How does the U.S. protect itself from what is clearly bad international news?
Yeah, I mean, I think we're watching and sort of waiting to see what happens in many of these countries that are experiencing third waves, and some of them fourth waves. Our vaccination rates are higher, which is great to see, but we're also watching the variants that are moving through these countries very, very carefully. I think the key for us in the U.S. is that as we sort of see our increase in vaccination rates, that we don't let our guard down, that we maintain those measures that we know worked well for us earlier in the pandemic and continue to work well. So maintaining distancing wherever possible, limiting your exposure to other people, particularly unvaccinated or vulnerable people, and wearing that mask, which continues to be a really important measure that we know works.
Lauren, you say that, and I know that from a health perspective, it makes sense to take all precautions. From a social perspective, people people are saying, forget about it. I want to go out without a mask. I want to go be with my friends. I want to go out to eat. And that's what we're seeing, regardless of whether they're vaccinated or not, frankly. What is the potential development based on the increase in cases that we're seeing overseas, based on the fact that people in the U.S. are done, they feel like they can be done based on the vaccination schedule here? Extrapolate out what this could look like.
Yeah, I think our worst fear is that it looks like those other countries, right? And so if we let our guard down too early as we're getting this really protective group of highly vaccinated population. So as more and more people get vaccinated, if we let our guard down too early, we could be following many of those countries in the same path. We could see.
You really think so? Because, I mean, given the level of vaccination currently in the United States, we're already seeing transmission start to go down. You really think that there's a risk we could see a situation like India or Japan?
I think that there's a risk that we could see ourselves on the path, right? So I do think that our third wave or fourth wave potentially could be muted, but I think that relies on continuing these measures as we get more and more people vaccinated, and as we move into summer, hopefully seeing a reduction in cases. But I do worry that if we just simply drop all of these things that we know work well while we're trying to get people vaccinated, that we will see a pretty significant uptick in cases, and that our hospitals will see that increased strain again.
Lauren, it's good to catch up, to get your perspective. Lauren Sand there, Johns Hopkins Associate Professor of Emergency Medicine.
Wow.
I think Lisa just trying to work out whether she can take this mask off in the next couple of weeks after receiving a second dose.
But John,
yesterday.
I'm reading about India. The Bloomberg coverage on India has been outstanding.
Like this for the rest of the
You're going to stay masked up.
John, I'm sorry. The news out of India particularly is
I agree with you, Tom. I agree with you. The news out of India is grim. And I think that the airline story over the last 10 days,
You've been way out front on that.
But I think it's really captured the divide between a better domestic economy, domestic travel here in America, almost fully recovered on the leisure side. But international business travel, we're a long way away from that. And the sequencing of reopening, this is going to happen in waves. I know the economy and the market often treats this as just one big thing, Tom, just one big movement. This is going to happen in waves. It won't happen all at once. And I think the airline business, just over the last 10 days, has clearly captured that. 10 straight days of losses.
Well, we see it with the boom economy and the United comments that we saw the other day. John, give me a window into Frankfurt tomorrow. Give me a window into why this ECB meeting is different.
I think there's a bit of pressure on the leader of the ECB, President Christine Lagarde. They've talked about front-loading some bond buying, and it's not showing up on the data in a big way. So there's going to be some pushback, I think, in the news conference tomorrow on that. Just how many bonds are they buying? And if they're going to front load, what does that actually look like? Because right now we're not seeing it in a significant way. Christine Lagarde, the ECB president, has been criticized by many, many people for her performance in these news conferences. Many people are reluctant to talk to me about that on the record, on the air. Behind the scenes, though, there's some frustration, I can tell you that, at least in the markets community, from market participants, from economists alike across Europe.
And to be clear here, the great distinction is they don't have a boom economy. I mean, just when everything's said and done, they don't have anything like China, like the United States.
And also there was a different approach with the furlough programs and some of the social programs, entitlement programs across Europe compared to the United States as well. So that snapback that you saw in America, you might not see the same kind of snapback in Europe, largely because of the policy difference between the two continents. But the vaccination rollout has been the clear differentiating factor, hasn't it, over the last year or so, over the last several months. The vaccination effort in America has been stellar. In Europe, it's been really difficult. But now we're starting to go through that inflection point, that turn. Clearly, things have improved in Germany and France, in countries across Europe. And we want to see a whole lot more of that. Away from making a market call, we want to see a whole lot more of that so we can get back to business.
All of you on radio and television, we are fully vaccinated. It's been ages coming, and of course, it's the great team support that we've had here, working remote, working here at 731 Lexington. Lisa Abramowitz suffering the second jab yesterday. Lisa, side effects? I had a little bit of fever.
You really want me to tell the world that I have a sore arm? I have a sore arm. That's basically the gist of it. I feel a little loopy, so I'm going to basically excuse anything that I do that's
called doing a pharaoh when you're loopy like that. And the reaction John was yesterday.
It's very personal and very unique.
Exactly.
I felt very, very fatigued and still do today. Others have just sort of marched on and got through it all right.
I had 2 martinis and the pain went away.
I've got to say, for me personally, reclaiming my freedom after this, I think that's something I'm looking forward to doing.
It is not a small thing.
Coming up in the next hour, looking forward to catching up with the former governor of the Bank of England and UN Special Envoy for Climate Action and Finance, Mark Carney.
Focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We've just been hugely stress tested here, right, with this bond yield tantrum, and sort of markets sort of survived.
You're looking not just at the peaks, right? You're looking at the sustainability of these trends.
What we have to question is that have things structurally really changed?
What the bond market is telling you right now is not so fast. Fed has the upper hand.
People are still assuming that the Fed is not going to have to or be able to tighten dramatically in this economy, just given where neutral rates are.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equities with a lift in the last 10 minutes, up 0.1% on the S&P 500. It's the pause in this market, in the reopening cyclical trade of the last couple of weeks that I think has got everybody's attention, Tom, at least in the last couple of days with that move in small caps, lower, much lower.
There's been an adjustment, and I'm going to go to David Kostin again. I've mentioned this 4 or 5 times. I love his idea that it's a micro market of micro news and micro stories, and they coalesce, John, around that pullback in this great rotation.
At the epicenter of that, a bond market that's some 20 basis points off the highs of the close last month. 174, the closing high at the end of March. Right now, 157, 158.
Yeah,
we're taking a pause, Tom.
You're taking a pause. I don't know where to say the limit is 162 or 160, but we're certainly to a lower yield, higher bond price. And like a rock, the real yield, a negative 0.76, John, that is not migrating towards a higher inflation, better real yield space.
You're familiar with the debate, Lisa. It's pretty clear. On the one side, you've got the pause crowd. On the other side, you've got the reversal crowd. We've tested the limits of that Treasury market sell-off.
And when we talk about the Treasury rally, they got a lot of people confused. Why are yields going down on the back of good information? There are technical underpinnings of that, right? There was a huge rash of bond sales from the biggest banks. There was this perhaps short squeezing. This idea that is that driving the narrative, that what does the bond market know that we don't, for all of the equity bulls out there who've been going into the reflationary trade. And I wonder how much that's actually driving the action that we're seeing this week, John.
Don't you always love that takeaway? What does the bond market know that we don't? As if there's some secret in the bond market that market participants are keeping from other market participants.
Well, I think that you think about bond.
So confused by
hold on a second. Bond investors typically look at the bottom line. They look at whether they're going to get repaid.
Right.
And so if all of a sudden people are concerned, and you're not saying this in credit.
They don't talk to each other. Don't call up their equity friends. Don't have a chat.
They sit at different lunch tables.
They say to their colleagues, Tom, don't share this. Don't talk to them. It's a secret for the bond market.
The bond market people look around the corner, John, better than anyone else.
That's right.
That's it.
Look Equities at that price action.
On the S&P 500.
I don't buy it,
3 points on the S&P. We advanced by about 1/10 of 1%. I know the bond market crowd love to hear this. So out in front of everybody. Yields up a basis point or two, 157.49. Euro dollar 120.10, down by about 0.2%, holding on to that 120 handle going into the ECB tomorrow, Lisa.
All right, today I'm looking at 10:30 a.m. EIA coming out with crude inventories. This has been a huge push-pull, and we've seen a pretty big rally in oil that has been stalling out a little bit over the past few sessions. The idea here is that we have seen inventories come down dramatically. Can that continue given the resurgence of the virus in places like Japan, in India, and given the fact that you are starting to see rumors of inventory starting to build back up in the United States? Then at 1 p.m., the U.S. is selling $24 billion of 20-year notes. Interesting to see what the demand looks like. These have not been messy auctions. That's been reserved for the 7-year. Still interesting nonetheless, given some of the drama, the rally in treasuries that we've been talking about that has stalled out. It's pretty calm right now, but interesting to see whether we get any indication of foreign demand in particular. And today, Apple, Google, and Spotify executives are going to be appearing ahead of a Senate antitrust committee. This we were talking about. We talk about it a lot. We thought that it would pick up. We're not talking about it, John. It does seem like something hanging in the background for a lot of these big tech names, especially as you start to get a more populist shift, even within the Republican Party. But so far, it's been all smoke and not a lot of fire.
What does the Fed know that we don't know? That's one of my favorites too. Haven't heard that one for a while. Netflix down by about 8% in the pre-market, off by 8.3%, Tom. Big miss on subscribers. Subscriber growth is not going to be anywhere near in line with what some people expected for the year ahead. It's been tough after a massive year through 2020. Pull forward seems to be the phrase of the morning for this particular stock. Competition is something they're pushing back on, Tom. They don't think this is a competitive story. It's not a competition story because some of the international markets they were slowing down into does not have the same competition we have in America.
I don't know what to make of it, John. Full disclosure, I've never been a fan of it because I'm waiting for profitability. They claim they're going to have a sustained profitability at some point, a sustained free cash flow. John, what I found interesting, and again, I'm a complete hack on this compared to Paul Sweeney, is the idea that they were saying they're having trouble making content, obviously, because of the pandemic. And yet, to me, they've been on fire. They just seem to, they have show after show that seem to have some traction. I just don't know.
I think it was the team over at Lightshed who just put it simply, Tom. There was nothing to watch in Q1.
Yeah.
And there might not be anything to watch in Q2
careful analysis by Rich Greenfield.
There we go. We're down 8.5% on Netflix. The credit story certainly improved over the last year.
My word.
Equity story struggled this morning. What's that, Tom?
Surveillance Gambit. I'm looking up at the
surveillance Gambit.
Yeah, I'm looking up at the pieces of surveillance.
This show is transitory.
There's
it's really not, Lisa, as you know.
There's the two-step spread.
Talking about the Netflix credit profile, I think that's fascinating because actually, if you look at what's going on, they actually reiterated their view that they were going to become cash flow positive, right? And that they're actually going to initiate potentially a dividend payment type of program. So this idea here, John, is that if you look at what they actually said, it was actually pretty positive.
For credit investors, yeah.
Yeah, for credit investors and, sort of sticking with the same line that they had before, even for equity investors.
The credit investors want to get paid. Equity markets, they want to see growth, and right now that growth is not in line with what was expected.
See, John, how we're so, we're just like trying to get through it on Netflix. Who the hell knows? Lisa's taking this seriously.
I know. I've noticed that on several fronts this morning.
Lisa, it's Netflix. We're at home. Don't watch that. Paramount Plus. Who watches it, etc.
Have you got Paramount Plus, Tom?
No, I got rid of it.
Yet? You got rid of it?
Tried
How long
it.
did that last?
We had SpongeBob Weekend and we got rid of it.
SpongeBob Weekend? What's SpongeBob Weekend?
Oh, the Keen household.
It's some culture.
How are you watching TV these days? Hulu or YouTube? What are you doing?
No, I'm watching Red Sox get it done. Padres are they're just dying.
Watching baseball.
They're
but how are you
dying.
watching baseball, Tom?
Yeah, I'm watching some baseball. I'm watching National League ball, John. I'm sort of in a traditionalist mode. It's sort of like watching Manchester City. It's sort of, traditionalist.
Gina Martin-Adams joining us now, Bloomberg Intelligence Chief Equity Strategist. Gina, good to catch up. We won't talk about anything we just talked about for the last 5 minutes or so. We'll talk about this equity market, the stall we're seeing on a cyclical side of things in the airlines, in the small caps. What's your take, Gina?
Yeah, I think a lot of this is simply low-vol stocks actually got extremely oversold, and we're seeing some rotation out of cyclicals into low-vol stocks. Our quant strategist, Chris Skane, did some great work on this in the middle of March, actually. Low volatility stocks like the consumer staples, healthcare, utilities, real estate of the world just got completely left out. for the last year were more oversold than we've ever seen in the records, in our records anyway, and are actually trading in line with the index on valuations, which is a complete oddity for the last decade. So I think what's happening broadly in the market, given we're only down about 1% for the S&P 500, is really a story of rotation, not a story of a market sell-off. I think also at the same time you get to a point where value and small cap stocks were extremely overbought, in particular small caps.
Right.
Really leading the charge. So to me, this is a story of just a rotation, investors taking advantage to take some profits on winners, add to some losers in anticipation of a market that maybe slows down its rate of gain but continues to churn upward over time.
You know, Gene, I'm a real sophisticated on this. I go to the WEI index and I look at the 12-month trailing return of Dow, S&P, and NASDAQ, and these are numbers you and I have never seen. I mean, we're addicted to 47%, 51%, and up 67% 12 months trailing. Now what?
Yeah, I think it's a really good point. Our view is that stocks actually still have some fundamental upside from here, but it's a slower gain. Our fair value model for the S&P 500 in fact suggests that over the 12 months from March 31st, we likely have a gain closer to 6 or 7% as opposed to the significant double-digit pace of the last several years. I think the characteristics of that gain also probably change. The characteristics being it's no longer a gain in stocks driven by valuation expansion on the heels of lower interest rates, but instead it's a story of earnings recovery really driving price. And we're certainly seeing frankly magnificent earnings recovery emerge over the course of the first quarter earnings season. If you just look at the data, at the end of the year, we were anticipating about 3% sales growth and 15% EPS growth in the first quarter. We're more than doubling that pace already. So very, very strong earnings recovery. I think that the skeptic says, oh, it's just easy comps. It's so much more than just easy comparisons to a year ago. Companies are showing very, very strong recovery, and I think that's what's keeping stock prices moving higher. Yeah. Just a slightly slower pace than what we've seen over the last year or so.
Gina, there was a strain of thought that if interest rates rose significantly, that would hamper the equity rally. What about the opposite thing? What if interest rates, what if benchmark yields, benchmark 10-year yields went down to 1% by year end, as HSBC suggests that it will? Yeah. Will that be worse for stocks because it indicates slower growth that can't support these types of earnings that we're seeing currently?
Absolutely. I was never in that camp that higher rates are going to impede the equity market. As a matter of fact, what we see over time is the correlation between stocks and bond yields is very positive and consistently positive. It's when that correlation breaks down that you have to get concerned. So I completely agree, Lisa, with the notion that if we have a bond market that rallies substantially, it probably does indicate some degree of weakness is emerging in the economic outlook. Something has changed in the outlook for inflation. Those two key fundamentals are pretty critical to maintaining the outlook for stocks at this moment in time because obviously, as I just mentioned, we're definitely earnings dependent. So I think that stocks and bonds should move together. In particular, at this stage of the cycle, it would be completely anomalous to see otherwise. We need to see yields continue to generally creep higher. We need to see the yield curve continue to become more upward sloping and credit spreads remain tight to maintain our trajectory in the equity market.
Gina, always good to get your perspective on the market. Gina Martin-Adams there, Bloomberg Intelligence Chief Equity Strategist. On the equity side of things, a couple of things to keep up to speed with this morning. Netflix down by 8.5% on a subscription miss. I've got to say, a monster subscription miss. On the equity side, bad news. On the credit side over the last year, much better news for that particular company. For the airlines, down for 10 straight sessions coming into Wednesday. S&P 500 airlines have lost 11.6%, Tom, over the last 10 days. It has been pretty rough out there for some of the consumer discretionary names, including some of the airlines too.
It's a pullback. Like Gina said, we're back down 1%, John. I mean, I really, we're allowed to pull back. I mean, I thought, we've heard that from a number of our conversations.
That I agree with you on, Tom, that we have clearly stalled on the small caps since the middle of March, down another 3% and change so far this week. That's where the conversation is at the moment. Euro dollar 120.09. Yields 157.14. Your equity market down not even 0.1%. We're positive a single point now, 41.27. This is Bloomberg.
First Word News, I'm Ritika Gupta. In Minneapolis, former police officer Derek Chauvin has spent his first night in jail. A jury convicted Chauvin of second-degree murder and other charges for killing a black man, George Floyd, when he kneeled on his neck for more than 9 minutes. Chauvin will be sentenced in about 8 weeks. He could face decades in prison. White House officials have told supporters they will pledge to reduce U.S. greenhouse gas emissions by at least half by the end of the decade. That's an almost doubling of the nation's earlier commitment. The goals being discussed ahead of this week's International Climate Summit. And that rebel soccer league in Europe has fallen apart just days after its launch. The chairman of Italy's Juventus club says the project will no longer go ahead. The collapse was inevitable after all 6 English teams involved pulled out of the so-called Super League. The idea was blasted by fans, politicians, and soccer authorities. The vaccination drive has made U.S. airlines optimistic about a summer travel rebound, but their upbeat outlook is clouded by international markets that just remain out of reach. Just this week, the U.S. State Department said it would declare about 80% of the world's nations no-go zones. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Okay, traders, it's time to place stop on profit for British pound, and I'm going to place it. So if you follow my trade and if you already sold short at 139.31.3 British pound, please place stop on profit at 139.29.3. We'll have 2 pips. So you will see you'll have to find out from your broker how much broker pays you per pip. This way you will not lose any money if straight away if something happened and the pair will change its direction. Okay, so good trades for all new guys who want to get the strategy, who want to trade other pairs. Maybe we do not give any advice, so if you want to find out more, please get the strategy. You need to get the strategy. It's from company.co.uk website, and you will trade. You can trade basically anything. Most all stocks, securities that tradable. That includes if it's in UK, FTSE 100, Dow Jones. No small cap, because the point of day trading to have small spread between buy and sell orders. So usually if you trade AIM market, for example, sometimes spread can be like 0.5%. We don't trade this way. We make relatively small profit, but every day. This is how we double or triple our investments within 6 months, 8 months, 1 year. Okay, I'll speak to you later. Stay safe, and let's look for other pairs that we can trade today.
Changing monetary policy while we're still in the pandemic tunnel.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
I would not call today's verdict justice, however, because justice implies true restoration. But it is accountability, which is the first step towards justice. And now the cause of justice is in your hands.
Keith Ellison there, the Minnesota Attorney General from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Farrow. Going towards the opening bow, 2 hours and around about 12 minutes away. Here's the price action for you on the S&P 500. Equity futures shaping up as follows. Positive a single point. Unchanged basically on the session after a couple of days of losses. Into the bond market, yields look like this on a 10-year, higher by a basis point to 157.14. In the FX market, euro-dollar slightly negative by 0.25%. Euro-dollar 120.07. Just want to bring you some news from the Financial Times around this European breakaway Super League that has unravelled in the last 24 hours, with 6 of the big English clubs pulling out one after another yesterday afternoon. This coming from the FT. League Super League documents show clubs signed up to punitive exit clauses worth hundreds of millions of euros designed to lock them in once it began. So, Tom, it is not the end of this at all. As these clubs exit something they agreed to, it's becoming a little bit clearer, perhaps, that there are some significant fees that might have to be paid to reach for that exit door.
Well, we will see. Certainly everybody's out, and the game will go on. Tottenham playing this afternoon against Southampton. There'll be other games as well. Right now, and particularly for our international audience, we are absolutely thrilled to bring you Mario Parker. As this nation stopped yesterday afternoon for a verdict of a trial in Minneapolis, I lean back on those from the Midwest. Martin Cast at NPR, of course, out of Carleton, and our Mario Parker, our White House reporter out of Benedictine in the University of Illinois. Mario, I want you to explain to our audience the importance that casts the character of Judge Cahill in Minneapolis in this trial. What was it about the Midwest that colored this trial?
No, what we saw front and center, at least for the last 4 or 5 years, is that the Midwest has been, just front and center in American politics, whether it was the previous administration, whether what we saw in the election of Joe Biden as well. And that's encapsulated in many ways in what we saw in the George Floyd trial, right? In the heart of the Midwest, in Minneapolis. We saw the protests, the unrest, the tensions between the communities, between the police and the communities of color as well. And then yesterday we saw a result that we quite frankly have rarely seen in the country, and in the conviction of Derek Chauvin.
Is there a middle ground in Washington, or are we a nation polarized within the House, within the Senate, and of course within the White House?
We are polarized, but there's a caveat to that, Tom. I mean, you saw that yesterday, Tim Scott, who is the only black Republican senator from South Carolina, he issued a pretty strong statement in support of the outcome of the trial. You saw Amy Klobuchar from Minnesota as well issue that. So we see some glimpses of bipartisanship. There is the typical Washington gridlock. That's not to be mistaken. But there are signs of some type of bipartisanship. There are some glimmers that Washington can come together and get something done.
Mario, this is not just a U.S. story. There has been an international response with a number of leaders of nations from France to the United Kingdom weighing in on this. What is your view in the importance internationally, both for the United States and more broadly for race relations?
Well, what we saw over the past year is something that we haven't seen probably since the 1960s. We saw widespread protests. We saw that videotape of George Floyd's death galvanized activists the world over. We saw the Black Lives Matter movement spread from the U.S. to Europe, as you mentioned. And so it threw a lot of support. It raised awareness. We saw everything from just on the ground people kind of of being engaged, all the way up into corporations looking at themselves in the mirror and trying to make some really tough decisions.
There's also a question of whether this verdict galvanizes the movement toward police reform, which we heard a lot about over the past 12 months, or whether it puts a damper on it because it does give the impression that in this case, justice was served. What's your view from the people who you speak to in Washington, D.C.?
Well, as I mentioned, there is gridlock. There's no doubt about it. There's Joe Biden President Biden used yesterday a significant amount of his remarks to talk about or throw support behind the George Floyd and Policing Act. That passed the House some time ago. It's been languishing in the Senate. The White House says that it's been engaged on Capitol Hill and in negotiations to try to get that across the finish line. But there's a 50-50 tie in the Senate. There's the filibuster still. There are some tough, there's a tough hill to slog in order to get that across. But again, as I mentioned, there are some glimmers of hope in terms of bipartisanship. There are some people on both sides of the aisle that at least recognize that something has to be done in terms of police reform.
Mario Parker, President Biden has suggested a second term is in order. The jury's out on that. But if he does that, he's really trying to reframe a relationship with the unions. Can President Biden reframe a relationship with police enforcement officers nationwide?
Well, that's going to be really, really tough for him. We've seen this delicate dance that he's had over the course of both his campaign and then in office, all the way up until yesterday. We saw the president express very, very sympathetic feelings toward the Floyd family and that plight, and also communities of color. But he also was careful to acknowledge that not all police are bad, to acknowledge that there needs to just be systemic reform, that most police officers want to get up in the morning and do their job and come back home. So he's trying not to inflame tensions there. There are some Republicans who have said that he's too soft on crime, that he's anti-law enforcement. We saw that thing pop up during the campaign. But he's in a tough position where he's got to thread the needle here, and he has to kind of pull off this delicate dance.
Hey, Mario, it's good to see you. Come back soon, sir. Great to catch up. Mario Parker there, Bloomberg News White House reporter. How are they doing, Tom?
The White Sox had to face the Red Sox. It was uneven.
The Red Sox, top of the pile at the moment, along with the Mets. Aren't you a Mets fan, Lisa?
It's hard. I don't talk about the Mets, and frankly,
you can talk about them now.
Yeah.
You can come out now and you can talk about them.
Lisa, John, the only way we're going to get Steve Cohen on the show is Abramowitz.
To talk about the Mets. Yeah, he'll have a very hard discussion.
Good morning, Mr. Cohen.
Good morning, Mr. Alarian, who is suffering through the Mets record. Perhaps they're winning, but it's always temporary. It's transitory with the Mets.
Please. It is.
There we go. Drink. Coming up, Scott Brown, Raymond James, chief economist. Then later, Mark Carney, formerly of the Bank of England, on climate change. And, of course, on monetary policy too. Tom.
Lenny Dykstra hit that ball in Game 3 in 1986. It was last seen over Everett.
Still going.
North.
Still going.
Still going.
Still going.
Oil Camp Boyd tossed the orb in, and Dykstra crushed it.
Should be a baseball commentator, Tom.
We're doing a play-by-play of something that happened.
There's a future in that for you.
20 years ago.
And the rest.
Yeah, but Lisa, I didn't name my kid Buckner.
Okay.
35 years ago. Yields up a basis point, 157.14. Equities up a single point, 41.27. Gives you an idea of why we're talking about basis ball. Muted price action. Euro dollar 120.07. On radio and TV, this is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, live on TV and radio, here's the price action this Wednesday morning. Equity shaping up as follows, unchanged on the S&P 500. Not much drama here whatsoever. The Nasdaq down around about 0.2%. The Russell bouncing back by about 0.5% after losses north of 3% so far this week. Monday through Tuesday, not pretty. Speaking of not pretty, ugly. Switch up the board and get to this. A chart of what has happened with the airline stocks over the last 10 days. 10 straight days of losses. Brutal. And those losses tally up to a loss of 11.6%. And I think what this reveals is the struggle, not domestically, but internationally. That's the focus over the last couple of days. We've moved from concerns from Brazil over to India. International travel is not going to reopen as quickly, quite clearly, as what has happened domestically here in America. And the airlines are set to struggle just a little bit more. This won't happen in a straight line. Reopening is going to be sequential. It will happen in waves. Finish on this then. In the bond market, Lisa talked you through the supply, 20-year maturity coming a little bit later. Yields today up about a basis point on 30s. Where are we? 227. On a 10-year, about 157. This cyclical rally has stalled. We talked about the commodity market, February through March. We saw the same thing in EM as well. Small caps, the middle of March. The end of March, 174 is your closing high on a 10-year yield. And since then, Tom, we have struggled to get any traction to push yields higher. 157. I think that's some 20 basis points off the intraday highs of the year so far.
John, we're benumbed by 157. I mean, you're right. It's been very much stasis, but I agree with you. It's the greater move over the last number of weeks, and I think we're just sort of numb to it, diving into earnings season.
I agree with you, Tom. We agree on something. 227. Doing that a lot recently, aren't we? Just agreeing with each other.
We're just out of sync. I mean,
227
has AC Milan said they're out of the Super League?
I haven't seen that yet. I just imagine there's not going to be a Super League, so I imagine they're going to be the next to go. But if these fines are real, I think this could get really interesting in the next couple of days. Just how much do they have to pay to unravel this? And if the English clubs went first and they're to blame, are they the only ones that have got to pay? Or does everyone have to pay to disband this thing?
The major debate, John, is the Apple show last night. Romaine Bostick and I were talking about it, and I think Romaine looks good with a pink iMac.
A pink iMac. Okay. So I'm going to let Romaine speak for himself. I'll stick with blue. Romaine, please, take the floor. It's yours.
All right, well, Apple shares not doing a whole lot this morning. Of course, the biggest mover out there this morning is Netflix, of course, down 8.5%, right around that 503 level. You've been talking about it all morning, of course, about a 2 million miss on the subscriber growth in Q1 and about a 3 million miss on that forecast for Q2. Now, on the upside here, you have a growth stock that's not quite growing, but you have a balance sheet that is improving. Keep in mind, net income did actually double here year over year, and you got about $6 $692 million in free cash flow. Furthermore, the company did say that it's actually going to spend about $17 billion this year on new programming, and it won't actually have to borrow any of that money to spend on that. That should actually be relatively good news to investors. But keep in mind here, you're talking about a company, when you go back 4, 5, 6 quarters ago, we weren't talking about HBO Max or Discovery Plus or Paramount or all these other competing services here. That's what Netflix is up against. Reed Hastings seemed to brush off any concerns about competition.
He did.
We shall see. Roku getting dragged down in this as well. And then later tonight, we're going to get earnings out of Lam Research. Keep an eye on this stock.
What do they do?
This is chip equipment. Shares up about 1% here in the pre-market. They've been a big beneficiary of the chip shortage here, expecting to be about 50% year-over-year revenue growth, which is pretty phenomenal for them. The big question is, how sustainable will that be? How long does this chip shortage go on, and how much do these chip equipment makers actually benefit from it? I want to show you 3 other quick stocks here that are really tied to the reopening trade right now. This is Intuitive Surgical. They came out with earnings. Of course, they make these robotic surgery devices. This is a lot of things that are used for elective surgeries and non-emergency type surgeries. This was a business that effectively collapsed because hospitals had to focus on COVID during the pandemic. The Intuitive Surgical showing signs of life here, that we are coming out of the pandemic. Those elective type procedures are coming back. Norwegian Cruise and the cruise lines getting an upgrade over at Goldman. Those shares higher here, up 2.5% in pre-market. And Citrix Systems, which makes all this sort of virtualization type of software that allows you to work from home, Tom. Those shares also higher here, getting a nice upgrade. Analysts basically saying that work from home trend, while we are sort of going to go back to the office, a lot of the trends that underlie that are going to persist.
Now, the close, of course, so many of these earnings coming out in the afternoon. Mr. Bostic and Taylor Riggs will join him.
And Caroline Hyde.
And Caroline Hyde will join him as well. Just nailed that. Riggs.
You remember Taylor.
Yeah, Taylor Riggs. Okay, very good. Right now, and this is a joy, Scott Brown joins us with Raymond James. And what folks, is that every school is different in academics. Scott Brown was weaned or issued by the University of California at San Diego. It is truly one of our most original economic programs. It is a jewel of American academics. He had the honor of studying not only under Engel, but under Granger, which means he has statistics absolutely nailed. Scott Brown, I want you to give us the econometrics right now of a guess of what wage growth is going to do. I can't do it. Can you look out with the Brownian crystal ball and tell me what wages are going to do?
Well, average hourly earnings are a notoriously bad statistic because it depends a lot on the composition. So, for example, last year when we lost a lot of lower paying jobs in the service sector, you saw the average hourly earnings number jump. And now as those workers are likely to come back, we're going to like to see big gains in the service industry. We should see that average drop. So it doesn't really tell us what kind of pressures are building. Fortunately, we do have something called the Employment Cost Index, which is due in just a couple weeks, and it doesn't really get a lot of attention from the markets, but it corrects for this compositional issue, and it also includes benefit costs. So it gives a much better indication of labor cost pressures. Now, in addition, you have to factor in productivity, and the productivity figures are all messed up. Similarly, because you lost all these low-end productivity jobs, so it looks like productivity is higher, and then as they come back, the productivity numbers are going to go down. But you got to do it maybe industry by industry, and you may see some wage pressures. I think this is probably for me one of the biggest questions is that we're looking at faster arrival of vaccines, much greater fiscal stimulus. All those things are very positive for the economic outlook. But matching unemployed workers to available jobs could be a lot difficult. It's not just the reverse of what we saw last year when people were getting laid off.
Yeah. Well, Scott, what data points are you looking at, high frequency data, that give you a better reflection of the actual picture, given all the noise that you just described and how you parse out the data?
It's very difficult. I mean, we used to just look religiously at the weekly jobless claims. They've been trending down, but they're still extremely high. And it's not clear what's going on. You got a lot of people that are refiling, a lot of people that are getting short-term work and then coming back and then filing again. So that's really difficult. And I think you really have to rely a lot more on the anecdotal evidence. And we're hearing a lot of stories of, the firms are really having a hard time finding qualified workers. You've had firms that have furloughed people last year, and when they're trying to ramp up again, and they can't find those furloughed workers. So it's going to be a little bit bumpy, and that may be challenging. Maybe we get some wage inflation. I think for the Fed, they would certainly welcome a little bit of wage inflation. But it's hard to really get it down to numbers. I think a lot of the numbers are just going to be really distorted.
Scott Brown, I want to go to James Hamilton in the one volume we all bought, we never read, Time Series Analysis. Is any of the statistics right now any good in a natural disaster as we have witnessed? Are you flying blind, or can you actually tell me you can extrapolate out intelligently?
It's very difficult when you look at something like GDP growth. I mean, the true secret is we economists, we spend most of our time trying to figure out what GDP growth was for the last quarter, let alone a year from now. So it's very difficult. And when you do a forecast, there's a point forecast and there's a certainty level around that forecast. If we publish those uncertainty levels, nobody would ever listen to us ever again. So I've always tried to tell stories, look at the individual pieces. Certainly getting a big handle on the Fed policy. And we've got a clear message from the Fed that they're not going to really hit the brakes here anytime soon. And it's going to be an interesting challenge. We're seeing the debate now on whether we may see some overheating. There's a lot of fiscal stimulus in the pipeline. It's not all behind us. A lot of it is still coming ahead, and that should ensure the recovery into next year. But, if we push too hard, then you start to get inflation. The Fed thinks this is going to be temporary, and for all accounts, you got all these base effects that we're going to see now.
Yeah.
But the inflation expectations, longer term, they're still pretty close to 2%, and that I think is the real key. If we start to see those inflation expectations really rising a lot more, say 3%, 4%, 5%, then that's going to be real trouble for the Fed. And then, of course, the danger is if that inflation, the Fed is wrong and inflation does really start to take off, inflation expectations start to take off, then they've got a lot more work to do to try to bring it down, and then it would likely involve, a painful landing.
Scott, what an interesting year ahead we have ahead of us all. Scott Brown there, Raymond James, chief economist. Let's turn to some news out of Italy. Juventus saying the Super League plan has few chances to be completed. My dear AC Milan says they must be sensitive on concerns over the Super League. It's just remarkable how quickly this whole situation has unraveled. Tom, I'll run through the price action quickly as well for us. No drama this Wednesday morning. Good morning to you all. Your equity market looks like this on the S&P 500, unchanged at 41.26 in the bond market. Yields up by not even a basis point now. Let's call it 157 on 10s. Euro dollar, Tom, just a little north of 120. We come in on the euro by about 1/4%.
Very good, John. John Farrell, Lisa Brownson, Tom Keene, we welcome all of you on Bloomberg Radio and Bloomberg Television worldwide to the very unretired.
Is a big announcement from the core of the financial sector.
Governor Kearney, I'm going to make it real simple. You were born in the northwest of the Northwest Territories. I'm suggesting none of our authorities have ever been as far to the Arctic Circle as you. The Arctic Circle is melting. Antarctica has glaciers moving. What is the urgency to a northern guy like you to get this done?
Well, there's an urge. Yeah, absolutely. We did drag the G7 up to Iqaluit, you might remember, Tom, about 8 years ago. So that they got close and they started to see some of the impacts. Look, there is an urgency to this. We're tracking as a world. You said Paris didn't succeed. It succeeded in the objective. It got people in, but the policies are still consistent with a world that's north of 3 degrees, warming north of 3 degrees. So this is a critical year for action. There's tremendous momentum now. We need to reinforce that momentum. And again, having 70 trillion of private capital coming behind net zero, which is what's been announced today, is the type of momentum the world needs.
Let me ask a rude question. How do you convince the United States Senate?
First, it's in the United States interests directly in terms of the impacts of climate change. It's also fundamentally, and I'll refer to the comments of Secretary Blinken a couple of days ago, this is fundamentally an issue, becoming an issue of competitiveness, of economic competitiveness. The world is moving in this direction. The firms that are innovating, that are lower carbon, that are part of the solution, and the financial institutions that are getting behind those solutions are doing very well. They will do much, much better. This is where the world's headed. The question is pace. The U.S., as in many things, should be the leader, can be the leader, and those countries that are the leader will reap the rewards as they should.
I love that Tom's still referring to you as Governor Carney. Mark, should we continue doing that? Do you want me to keep that up?
That's an American thing.
I haven't done that for a long, long time.
We're not rude like you lads from Britain. We always do that. We title
Mark had to put up with a lot of that in the news conferences on Threadneedle Street. I'll go with it. Governor Carney, I remember a news conference at the back end of 2013. You were fresh in your tenure at the Bank of England, and everybody was worried about bubbles elsewhere and why we needed higher interest rates. And I remember a line from you: we don't set monetary policy for inside the circle line. Now, if you live in London or appreciate the underground system in London, you'll remember that quote and you'll know what it means. So, Mark, I want you to help us understand the moment we're in right now as well, the financial stability concerns that go with very low and exceptionally low interest rates for a long, long time.
Two things, John, thanks for remembering that. We do set financial stability policy for inside the circle line, or the equivalent in the U.S. and Canada, around the world. So it is very important that authorities are focused on pockets of
economy over the past 13 months. Is this just without harm?
Well, no, I mean, everything, I wouldn't say everything in moderation, Lisa, but everything needs to be calibrated. The Fed and other central banks will have to make, as they always do, timely decisions on the tapering of stimulus, tapering first, and then in the fullness of time, with the recovery that we want and deserve, withdrawal of some of that stimulus. Fiscal stimulus in all jurisdictions needs to move more towards the type of support for private investment as opposed to sustaining individual consumption. I mean, and I'm saying that after the measures that have been passed in the United States and elsewhere. So there is a pivot on both policies coming, but where policy stance is today needs to be seen through. But absolutely, Lisa, there are some tough decisions ahead.
Governor Carney, if it isn't inflation, when going back to your issue as a special envoy for the United Nations, Secretary Treasury Janet Yellen said that climate change was the biggest threat to markets. That was the biggest threat, frankly, existential threat to the way that we operate. And we've seen the Fed take a more active role. Can you dovetail how monetary policy fits in with climate policy?
Well, first and foremost, the Fed's actions are related to financial stability risks, what John was talking about earlier. So making sure that as we're in this transition, that lending, investing is consistent with the industries of the future and not those of the past, and we don't build up large losses in the core of the system. Monetary policy is going to have to largely, certainly in the United States, it's largely a question of the classic supply-demand shifts in the economy, so more traditional monetary policy. I will say in the UK and in Europe, the way monetary policy is operated, the type of collateral that's used, the type of assets that are purchased, will be influenced by climate policy. And as a consequence, that will be yet another influence on the pricing of securities.
Governor Carney, Chrystia Freeland is making really quite a splash in your Canada, and I want to take it globally, certainly G7 and G8, but actually globally. Do we see in Canada, as we come out of this pandemic, a new interpretation of what government will do? Chrystia Freeland has made worldwide news with a more liberal approach. Is that a tone of the future?
It's recognition. Aspects of the Canadian budget are recognition of the inequalities that still exist in this economy, and very important. I think the centerpiece element in that budget is around childcare and universal childcare. And to speak as an economist, I mean, we're moments from you talking about Granger causality and time series analysis. Speak as an economist, one of the things, of course, what that's doing is an issue of social justice. It also is an issue of supply capacity of the economy. More women can work, broader participation in the economy. That's good and is right and is just, but it also supports growth. But in Canada, as in the United States, what I was saying earlier, the shift from support needs to come, from immediate support to households during the course of the pandemic, which is still raging here, unfortunately, at the moment, to that type of longer-term growth and a responsible fiscal policy that is consistent with longer-term growth.
What's so great about this, folks, in these conversations that John, Lisa, and I have is you get little windows for a split second into how competent these people are. As Mark Carney picks up on Granger causality and brings it right over to the political theory of his candidate. Mark Carney, I think John Farrow would agree with me that you are more qualified than any global thought leader, and I hate that phrase, Mark, to talk about what you learned in the United Kingdom. John Farrow has beat the table throughout this entire pandemic that there is a social contract in Europe and indeed in Boris Johnson's United Kingdom that is different than America. Out of this pandemic, are we shifting to a new social contract where we budget for the have-nots?
I think we are, and the starting place is different. As I think you summarized it well, Tom. The starting place is different in Europe, it's different in Canada, different in the US, but the direction of travel is similar. We've learned through this pandemic that we don't have as resilient economies and societies. I mean, individuals have proven themselves to be resilient to their great credit, but we haven't had the support, we haven't had the protections we need. And I can extend that analogy not just from financial stability to health and pandemics, but over to cyber and other issues where government needs to play a role, also playing a role in the adjustment of the economy. Now, in the end, the economy needs to move to the future, and the future, to grossly simplify, is sustainable and digital. So whereas we have that support, we also need the dynamism and the openness in order to move forward, or else we're supporting livelihoods of the past, not of the future.
Mark, we can save these questions for the end of the interview. We're there right now, so let's do it. Do you miss central banking? Do you miss the world of central banking? I'm going to get to the Brexit question in a second. Don't worry, Tom. Let's start with central banking first, Mark. Do you miss it, Mark?
How are you feeling, Mark?
I've been, John, Tom, Lisa, I've been in this room for 6 months. Yes, I miss it.
Mark, are the Maple Leafs going to finally break the curse, if you will, back to 1967? They haven't won since your Ute.
Connor McDavid and the Oilers, they're going to spoil it for him. Okay. You heard it here. I'm going there with the Oilers, Tom. Tom, I've silenced you. I can't believe it.
Yeah.
He has silenced you. That's unbelievable. I've never seen that before.
Just ask a Brexit question.
Do you want me to ask a Brexit question? I don't think Mark wants to answer a Brexit question. Mark Carney, before you go, let's finish on the story in the UK. Things have changed so much, the relationship with Europe. Has this ended up where you expected it to end up?
We're more or less at this stage, but we're still in the early innings, to use the U.S. expression, of the post-Brexit relationship. It will take a while to reestablish some of those relationships, including in the financial sector. I think the interests are still very much aligned, and I would hope that over time the degree of openness, cooperation will increase from this base, which is lower than it should be in the interests of both Europe and the UK.
Governor Carney misses the world of central banking, and I'm sure you don't miss those news conferences, though. Mark Carney, UN Special Envoy for Climate Action and Finance and former Bank of England Governor. Tom, we're going back a long, long time when we think about 2013, late 2013. There was so much pressure on the Bank of England to raise interest rates because of what was happening in the housing market. And we'd always go back to macro-prudential policy. There was this discussion then about macro-prudential policy. How quickly will we be having the same discussions in the next 12 months, I wonder?
You know, these are private conversations, but John, I would emphasize that all of my conversations with Mark Carney were to diffuse the productivity of London North across all of the United Kingdom. He was riveted on what he could do for Great Britain and not just for the city and for London.
And I think that line, Tom, about not setting policy for inside the circle line was just perfect. And for people not familiar with the undergrad system in London, the circle line is something that basically loops around Zone 1,
it's amazing.
the
It stops
epicenter
right
of
at
London. It just sort
and
of
it stops
loops
right at
around.
Claridge's. It's amazing how it does that.
You can take the Circle line from the city, Tom, out to South Kensington as well.
Really?
If you'd like to, just saying. And then you can walk from there down to Brompton Road towards
Up to
Harrods,
Watford Gap,
maybe.
okay.
Yeah, Watford Gap's a little bit further away.
Okay, and
we'll
then
talk
Leeds.
about that another time. Leeds is a bit further away from that as well. Great to catch up with the former governor of the Bank of England. More still to come on the programme this morning. Coming up, we'll catch up with Brian Levitt, Invesco Global Market Strategist, alongside Lisa Bravitz and Tom Keane. I'm Jonathan Ferro. Let's run through the price action this Wednesday morning. Set up as follows: 41.25 on the S&P 500, down around about a single point. In the bond market, yields higher by a single basis point to 157.14. Euro dollar with a 120 handle going into an ECB news conference and decision with President Christine Lagarde tomorrow. This one could get interesting in Europe. Vaccinations improving, the outlook adjusting. Euro dollar calls are from Deutsche Bank looking for 125, maybe north of that in the months to come. Does the ECB let yields run if they start to pick up and it's consistent with a better outlook? That's going to be an interesting one for the next couple of months, maybe. From New York, this is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Is there anything you think the Fed should be able to do to help people who are really suffering in the pandemic?
I think they need to be in the room with us as we make our decisions about monetary policy.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
This is really an extraordinary moment, I think, in terms of thinking about cures for genetic disorders.
Just been hugely stress tested here, right, with this bond yield tantrum, and sort of markets sort of survived.
We are looking not just at the peaks, right? We are looking at the sustainability of these trends.
What we have to question is that have things structurally really changed?
What the bond market is telling you right now is not so fast. Fed has the upper hand.
People are still assuming that the Fed is not going to have to or be able to tighten dramatically in this economy, just given where neutral rates are.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a simulcast radio. It is television as well. A lot going on now as we go to the ECB meeting. Today, we got some earnings coming out in America, all sorts of cross currents. John, our interview with Governor Carney. John, all of it pushed aside. AC Milan exits the Super League.
Have they exited as well? Is there anyone left, Tom? This Super League
I'm
falling
asking
apart.
you.
The miscalculation of some of the leaders of global football has been absolutely remarkable. And these are big, big names. John Henry, Florentino Perez, Andrea Agnelli. The Agnelli dynasty, been involved in football for decades.
What is the
pushing a
embarrassment
century.
to the Italian elite here? What,
I think
I
it's
don't know.
embarrassing to
Inter
everyone
Milan,
involved.
AC Milan, I don't get any of it.
It's embarrassing for everybody involved, and it's not a lack of understanding of the game of football. It has nothing to do with that. And I've heard that narrative come out of the UK, out of English football, that somehow the foreign owners don't understand English football. The owner of Real Madrid, Florentino Perez, he's been there for almost 20 years on and off, Spanish. The owner, the people that run Juventus, the Agnelli family. Could you get any more Italian than the Agnelli family?
Fair.
Tom Keene, come on. This isn't a lack of understanding. This is about money. And when Lisa talked about this being about debt, this is about losing money. And these big clubs want to consolidate their power to try and make more money. They've made a serious miscalculation. It's unraveled. The 6 English teams pulled out one after another in the last 24 hours. What's interesting now, the FT reporting that these are some binding contracts that will take money to exit. One key point, though, as the FT also reports that that money and that exit fee was conditional on the league starting. League didn't start. So I have no idea what the legal issues are. I'm not a lawyer.
Well,
I'm
who
going
do
to
you
be
mail
very
the check
interested to see
to?
what they look
but
like
John,
in the coming weeks.
Seriously, John, let's say I owe $200 million because I walked out of the league. Who do you pay?
No idea. Don't know what the contract looks like. No idea, Tom.
Lisa,
I'm with you.
and so much of this, Lisa, is a misallocation of free money. I mean, you talk about it in the high yield market. John talks about it on his property, the real yield. Look for that, folks. Friday afternoon and into the weekend. Lisa, this is just another example of money for nothing.
Well, I don't want to segue exactly to try and draw some sort of parallel between all of these stimulus and the situation with the European soccer leagues. However, there is a question, or football leagues, I should say. There is an issue here.
You should say.
There is an issue here, though, Tom, of the pressure points that have gotten exacerbated by the pandemic. The idea that there is debt to pay back, and what kinds of desperate measures does that take? And frankly, we see that with the airlines right now, right? The idea that they're not going to see that key international and business travel pick up that supports their bottom line. Domestic travel picking up dramatically. Guess what? It doesn't pay the bills. So how do you get sort of a rivalry, and how does it reshape the dynamic going forward, given how the pandemic has pressured the issues?
John, what did we learn from Governor Carney? I thought it was really stimulating about climate change. His comments, I thought, on his Canada were extraordinary, on Freeland and the budget debate there. And then you had some sensitive moments there on the United Kingdom.
I just remember being in the news conference a couple of times with then Governor Carney on several issues. 2 of them I think are pertinent right now. One is macroprudential policy and the risk of bubbles elsewhere because rates are kept too low for too long. There was some pushback and Governor Carney's tenure over at the Bank of England. The other was transitory, this issue of inflation. He let inflation run above target, north of 3%, in the same way that Governor King did. But Tom, there was a key difference. A lot of that was driven by a much weaker sterling. And there was also pronounced downside risk to growth. We don't have that in the United States. We don't have the same downside risk to growth. And that's what's unique about this moment. Upside risk to growth going into next year, and a Federal Reserve with a new reaction function, brand new reaction function, saying it's transitory, we'll let it run. I wonder what this Fed would have looked like maybe a couple of years ago, faced with the same scenario they're faced with right now, Tom.
Those levels are different. Yeah, sterling 139.22, euro 120. We've noticed the lift over 120, and of course the modeling by so many houses out to 125 and even out to 130. Let's complete the triangle. 108.10 on yen. Futures red, a little bit flat here. The VIX 18. 0.39. Brian Levitt joins us now with Invesco, their global market strategist. Brian, give me your take on the global pandemic. Our David Fickling has the essay of the week on the brutality of the pandemic to EM economies. How does that fold into the Invesco financial analysis?
Yeah, I mean, there's no doubt that emerging markets are being hit hard now. I mean, the early narrative was that the emerging markets had fared better, but clearly many of these emerging economies are struggling. I mean, you'd want to separate the different emerging economies, though. I mean, you still see an environment where China and a good part of Asia has come out of this fairly well. But obviously, you look at places like India and Brazil, it is still quite challenging. And it's likely to be challenging for some time now because it's going to take time for this vaccine rollout to find its way into these parts of the emerging world. Ultimately, we believe medicine and science will get out in front of this as it has in the more advanced world, but it's a challenge and it's going to take time.
Brian, what are you looking for just in terms of signposts to really indicate to you that this is just a pause, a consolidation of a big run in the last 6 months and not anything more sinister?
I mean, you look at all the normal stuff. I mean, the financial conditions are still very easy in the United States. Corporate bond spreads are still tight. The dollar hasn't strengthened meaningfully. The yield curve is still steep. And you're seeing very good signs of economic activity. Real-time indicators are, in many instances, booming in the United States. You don't see inflation expectations. They've risen, but they're not, accelerating. So right now, it's a good backdrop. The base case is still very promising for the U.S. economy and for financial assets. Yeah, there's tail risks. We all understand there's tail risk. You've talked about this idea of inflation getting out of hand, or on the other side, the pandemic, a resurgence in the pandemic. But in my opinion, this base case is still very optimistic for the economy and financial assets.
So, Brian, talk to us about what you want to rotate back into then, so to speak, to take advantage of the weakness, because small caps stalled middle of March. We've talked about that so many times on this show. EM equities topped out in the middle of February. You taking advantage of the weakness?
Yeah, I think you should. And it's all part of this reflation trade, this recovery trade. And so what you ended up happening was the recovery that took hold. A lot of investors kind of went along kicking and screaming. Then you had the move in rates. You had concerns that the inflation expectations were picking up. That was going to bring forward Fed tightening. If you bring forward Fed tightening, then you need to be concerned about the more so-called riskier parts of the market, particularly the emerging markets. You've got to be concerned about a tantrum and money being sucked out of the emerging world. And what you're seeing now is a bond market that is telling us, slow down a bit. Inflation expectations have not accelerated to the upside meaningfully, and the recovery continues to take hold. That should continue to favor things like small cap. You get a bit of a weaker dollar here, that should allow money to start to flow to the higher quality parts of the emerging economy. And so I think that trade persists. It's not indefinite. It doesn't go on forever. But so long as that recovery trade, so long as the economic recovery trade plays out, then small caps and emerging markets should perform well going forward.
What's your takeaway, Brian, from the fact that we just got earnings that largely were pretty good? I mean, they were mixed in some cases, but pretty blockbuster, certainly on Wall Street and a number of other companies. You've got economic data that's come out better than expected in the United States, and yet you're getting this pause in the reflation trade. How do you make sense of that?
There's always a bit of an irony, Lisa. It's always this year one markets boom and everybody wonders how it can happen if the economy's not good and earnings aren't good. And then in year two, the markets are a little bit more challenged because everybody thinks that it's gone on too far, too fast, it's overheating, and you worry that there's going to be a shift in policy. And that's what ends up causing a pause in markets, a move higher in rates, a bit of a strengthening in the dollar, a shift in policy expectations. You tend to get markets that go sideways, or you get some, even some volatility or drawdowns in markets. And so the market, 6 months ago, when everybody was wondering how it could go up, was assessing the environment that we're in right now, which was this is going to be a pretty good environment for the economy and for earnings. And so now assessing 6 months from now, is it inflationary? Is the Fed tightening? And again, I don't believe that to be the case. I think markets will continue their advance.
Brian, very quickly here, Greg Jensen and Kate Dunbar just published at Bridgewater, and they reaffirmed reaffirm an accelerating American economy. Acceleration can be a dangerous physics exercise as well. Is there downside to this boom economy? Is there downside to our second derivatives?
Well, I think the downside, the concern is that there's just going to be too much demand coming in all at once and not enough supply to meet that demand, and could become inflationary. The reality is, though, it's still an economy that's growing below capacity. There's still a high level of unemployment. And so while there might be a lag between the demand hitting the economy and the number of workers that could be rehired and the supply that comes back online, ultimately, I think that the supply side of the economy can match that. And we still have the long-term structural forces that weigh against significant acceleration in growth, aging population and others. So nothing structural has changed. We had a disastrous recovery. We're climbing out of that hole. It may get a little hot, but ultimately those structural forces should bring us back to a modest growth, relatively benign inflationary environment.
Brian, looking forward to getting things back to normal. Looking forward to being back on the trading floor, in the office with a team at Invesco again. Been too long,
Me
Brian.
as well.
Good to see you, sir.
Well.
Brian Levitt, Invesco Global Market Strategist. I want to turn you to the stock story of the morning. It's Netflix, down around about 8.5%. Big subscription miss. Just to put some numbers on that, the company looking for a gain of just 1 million new customers. This a fraction of the 4.44 million that were projected by analysts. Lisa, these numbers don't stack up. On the equity side, at least, not good news.
The interesting thing to me is how much good news was priced in, that basically Netflix themselves was saying that things would slow down substantially. Although they did slow down more than they had expected, they haven't changed their overall outlook going forward. The question here is, how much can they spend on content? Can they create the shows?
Yep, it's going to cost money, and it won't be debt funded maybe in the same way. And that's been the big change of the last 12 months. We're down 8.5% on Netflix this morning. Equity futures down 3 points on the S&P 500. Euro dollar 120.06, yields up almost a basis point, 156.61. Coming up in the next hour, later this hour, in about 40 minutes' time, David Rubenstein, the Carlyle Group co-founder and host of the David Rubenstein Show, peer-to-peer conversations, coming up a little bit later. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In Minneapolis, former police officer Derek Chauvin has spent his first night in jail. A jury convicted Chauvin of second-degree murder and other charges for killing a black man, George Floyd, when he kneeled on his neck for more than 9 minutes. Chauvin will be sentenced in about 8 weeks. He could face decades in prison. White House officials have told supporters they will pledge to reduce U.S. greenhouse gas emissions by at least half by the end of the decade. That's an almost doubling of the nation's earlier commitment, the goals being discussed ahead of this week's International Climate Summit. On Capitol Hill today, Google and Apple will come under antitrust scrutiny. A Senate subcommittee will question company executives about the way they run the marketplaces that give consumers access to millions of apps. Senator Amy Klobuchar says she'll ask about the fees developers must pay to be included in app stores. And shares of Netflix sharply lower pre-market. The streaming service added far fewer new customers than Wall Street expected in the first quarter. It even missed its own forecast by millions of subscribers. Plus, Netflix says the current quarter will be more challenging. A lack of new shows may be contributing to the slump. All this comes after record growth in 2020 that Netflix said was due to the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
How can it be right to have a situation in which you create a kind of cartel that stops clubs competing against each other, playing against each other properly, with all the hope and excitement that gives to fans?
That was Prime Minister Boris Johnson. What a week it's been. This has got to be the business story of the week worldwide. The collapse of the Super League that lasted about 48 hours from New York City this morning. Good morning. Alongside Tom Keane, Lisa Abramovitz, I'm Jonathan Ferro. Here's your price action this Wednesday morning. The equity market on the S&P 500 down about 3 points and off 0.1%. Coming off the back of 2 days of losses on the S&P, the Nasdaq, the Russell down more than 3% on the week coming into Wednesday. In the bond market, yields are higher by a basis point to 156.78. Euro dollar 120.06. Tom, let's just sit on that story. What a mess it has been. Some of the tycoons of the business world who have just made one of the biggest miscalculations perhaps in the history of sport, at least in the history of the business of sport.
In modern sport, I don't think that's off the mark, John. In my modern sport, I'm not going to go back to World War II, but certainly back to my youth. It's just been absolutely extraordinary. John, why don't you bring it up with Alex Webb here? He is in London. He has observed it. Maybe he's got some wisdom we don't have.
Let's bring in Bloomberg opinion columnist Alex Webb, and let's do that right now. Alex, your take on the week so far. It's felt like a month.
Astonishing, the roller coaster we've been on in just the past 2 days. And this is huge effort clearly from these big clubs to protect their revenues. On the one side, you've got clubs that are fan owned and struggle to compete with companies clubs that are able to raise equity and buy players that way. Then there are the ones that are owned by the Americans who are used to the American model of being in a defined league, being able to predict their revenue. They kind of came together and said, well, let's create a league that has no relegation or promotion, has a defined set of members, same year in, year out. Inevitably in Europe, where the kind of sporting culture is very different, the backlash was extraordinary from politicians, Prince William, fans on the street. It was, I think, commensurate as well. It's something that is treasured in this part of the world, that you or I could set up a football team tomorrow and be in the Premier League in a decade, hypothetically at the very least.
Alex, the leadership of football is going to change. Maybe already seeing that over at Manchester United. These names have been around for a long, long time in sports. Henry of the Red Sox, now of Liverpool as well. Perez of Real Madrid. Agnelli of Juventus going back decades. and decades. The changes that we've seen this week have been quick. What else is left now, Alex? How do you think the dominoes fall from here?
There is an underlying issue here that football or soccer is not doesn't have a sustainable business model. That from one year to the next, if you have a good season, you can be hugely profitable. The following season, if you're not as successful, you can post really painful losses. And so they need to find a way of evening out those peaks and troughs. I think there is a way of doing it. It just requires probably from the big clubs to sacrifice a little bit of revenue and say, we'll give up some of that revenue, and in return, we'll maybe get some profit. That will mean salary caps in the same way they exist in the NFL, for instance. And it'll mean better sharing of revenue with the teams lower down the pyramid.
Alex Webb, we were going to have you on to talk Apple. Let's do it briefly here. I mean, I think the Super League is really important as well. Alex Webb, what I noticed yesterday is the first order for the Hermes AirTag luggage thing was from John Farrell. I mean, I think Farrell looks good in a $449 leather luggage tag to go with a $29 whiz-bang.
I was wondering why you were so quiet.
Who is Apple talking to? I mean, they're not doing the iPhone. Who is Apple talking to in this product launch?
I mean, they make a huge amount of money these days from what they call other products. That's the thing that includes things like the Apple Watch and the HomePod, and that's a really fast-growing category for them. So if, another 30, 60 bucks here or there, these products, they're kind of pure margin. They are very lucrative. And so I think that it's topping up that part of the business with actually not a huge amount of R&D spend up front and not a huge amount spent on the raw materials.
Do they have competition? Where does Apple fit now with what we did 10 years ago? Samsung, Dell, Microsoft, all the rest of them? Or is Apple now in a world of their own?
I think actually the thing we're seeing is that increasingly the tech companies are expanding into each other's turf. We're seeing Apple make moves in advertising, for instance, and squeezing out Facebook a little bit. We've got Google getting more into hardware. Facebook, I think when we get into the world of augmented reality and smart glasses, Facebook really sees that as the next platform. Apple's doing the same. I think these are increasingly butting heads against one another.
What don't you buy, Tom? What are you pushing back against? What don't you buy?
Just a smart glasses thing. I remember I was here. I can't remember what the property was, John. Somebody brought in the Google glasses, and we had to try them on and make jokes about them.
To revolutionize everything.
John, has smart glasses ever worked?
Have they ever worked, Alex?
No, they haven't. But I mean, if you'd asked someone in, 1903 if a car would go down around a Formula One track at 200 miles an hour, the answer would also have been no. I mean, these are technologies that weren't mature 10 years ago. The question is, when will they be mature? It could be 5 or even another 10 years.
I always reflect on that 60 Minutes clip of the journalist that was asking about Amazon being bigger than Sears. Saw that recently. It got re-upped over the last couple of weeks. And Alex, the journalist, always looks so smug, saying, bigger than Sears. That's ridiculous. That's ridiculous. And I always just try and remember that. Don't be that guy. Try not to be that guy. Alex, it's good to catch up with you. You are the visionary. I'm not.
He's
Alex
just
Webb,
so visionary.
Bloomberg opinion columnist. Tom, you have got to be careful because sometimes in 20 years, some of the things that we're smug about sit here and say, this is ridiculous. Sometimes they're the things that actually take off.
Yes, that would be true. But, John, I think, I really got to talk about this. What is this air thingy? Like if you lose something,
I love
you
this.
Find it?
You love it, Lisa. Why?
I do. Because you can just stick it on your phone, stick it on your kids. You lose them, you can track them.
Stick it on your kids.
I mean, it's just this idea that you can track things digitally.
Idea.
Your keys.
I got vet bill with a Tiffany collar. We can put the Hermes AirTag luggage tag on the Beast.
Nice.
And
you
never
could do that.
Lose them.
Is that the luxury element of all of this for you, Tom?
The thing is so damn expensive, John. I think you need to have a padlock on the luggage tag.
Remind me the price of this, Tom. What's it going to cost me?
$449, I believe.
Goodness.
Maybe it's only
more than the bag.
On sale.
That's ridiculous.
More than the bag.
Yeah,
but not the kid.
Well, come on, but you're getting Hermes. It's RMS. FP is the symbol. Hermes International.
I guarantee you buy one before I do.
Okay.
In all
that's
seriousness.
True. Go on, Lisa.
I thought that, Tom, you were actually right, that this should have been an important meeting for Apple. It should have been an important launch, and it wasn't received as such. And I do wonder how much of a liability that is for Apple if they can't come up with the next iPhone.
They were in between, and Romain, I thought, was correct, and he undersold it, and it was closer to what Romain was looking for. What they're doing, Lisa, and again, it may come down to part shortages. Maybe they're setting themselves up for a huge September or October announcement announcement. There is a desperate need for enhanced, sophisticated Apple computers.
How many times, Tom, have we been talking about this? Steve Jobs, no innovation. Tim Cook can't get it done. And he just turned it into the capital return machine. For the stock, at least, it hasn't mattered. Just hasn't mattered at all.
I don't know. The colored iMacs, Lisa, are you going to buy two for the brats?
No.
You know, there they are. It's a
they
new
get
iMac.
air tags. They don't get new iMacs.
The discretionary spending of Lisa and me is a little bit different.
Very much so.
The discretionary spending over at the Keane household at the Apple store on the Upper East Side.
Mrs. Keane looks awfully good with one of those new iMacs. What color should she go for,
Sure,
John?
Mrs. Keane is letting you know about that already. No doubt. Coming up, Alberto Gallo on this bond market,
She's
Out of
like,
Risk
well, the
Investments
pink one's
portfolio manager. From New York City this morning, good morning, Tom Keane. The Pfizer hangover gripping both Lisa and I.
Yeah, you guys are brave. You're troopers.
Off a 10.
I would have taken the week off.
No doubt.
Flagship store in New Delhi. The iconic British toy store chain is set for a revival as the new owner and billionaire Mukesh Ambani looks to expand the brand in India. Planning to quadruple the number of outlets in India to 500 in 3 years. The expansion of Hamleys will help Ambani widen his retail portfolio as he transforms the oil and chemicals conglomerate into a consumer and technology giant.
No, I think certainly it is gaining popularity since last few years, and now more and more people are coming to Hamleys because it has a wide range of toys for all the age groups.
Founded in 1760, Hamleys has been struggling to make profit for a long time, and the pandemic has worsened its financial distress. The deep pockets of Asia's richest man and India's demographics could help Hamleys revive sales.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
From From New York City for our audience worldwide, live on TV and radio alongside Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. Here's the price action on the S&P 500 going into the opening bell about an hour from now. Equities down about 0.2% on the S&P. On the Nasdaq off by about 1/3%. Call it 0.4. Look out below on Netflix stock. We'll talk about that through the next couple of hours right here on Bloomberg TV and radio. Switch up the board into the bond market. 2s, 10s, 30s in the Treasury market. Yields are higher by a single basis point to 157 on 10s. On 30s to 226.42. And to finish on this, euro dollar going into tomorrow's news conference, a decision by Christine Lagarde of the ECB. Euro dollar 120.08, Tom. We come in around about 0.2%
Yeah, John, these are really important conversations. We're going to advance that right now. Alberto Gallo with us. John, I want you to go to Mr. Gallo with your wisdom here. But John, I first want to talk about in the Super League blow up. We've been making jokes about Leeds, but this is not funny. I mean, Leeds has succeeded over the last number of months, and the toughest thing in Italy, like Leeds, is Gallo's Naples, or Napoli, I believe it's called. I mean, the fact is there's a real parallel here, isn't there?
And Napoli has been one of the clubs in Italy that has actually managed to challenge Juventus' dominance over the last decade, coming close to winning the title a couple of times. And they are a great example, Tom, of a club that would have been frozen out of this European Football League with little chance of joining it. And the Leeds of this world, the Napolis of this world, that have had at times, some kind of European heritage, wouldn't be able to get back in and conquer those names. And I think that's the beauty of sport, that even if you're a small club, that somehow you can climb up the ranks and get it done at some point.
Give our American audience a window into this. We've got a guest qualified to speak.
Alberto Gallo, Algebris investment portfolio manager, was hoping he'd talk about the credit market. Credit fund. Alberto, we've got to start with Napoli first. Your take on the events of this week, Alberto, as a Napoli fan that would have been frozen out of all of this. What did you think?
Well, I think this is the time for markets to, and also society, to fight inequality. So we don't want it at the social level. We also don't want it at the sports level. So, you know, even though there's a few teams that are wealthier, you know, people want to have a game which is fair, and where also, you know, the less wealthy teams can compete. Same with society, right? We're definitely, we don't want to go in that direction to encourage inequality.
You're fighting zero rates as a portfolio manager as well, Alberto. How are you getting on?
This is a much tougher year because we have seen that with the extreme crisis that we got last year, you know, we've had central banks and fiscal policy all pushing down the accelerator. The result is governments have more debt, and central banks have had to do more. They continue to do more. What we see today is, you know, real yields are negative everywhere. And there is 60% of the bond market yielding below 1%. So, you know, before and over the last 20 years, it was very easy to make money in bonds. Now it's much tougher. And that's where alpha also surprises more and is more needed by investors compared to where we were before. It's much tougher, but we still find a few opportunities. However, I would say the second half of the year, we think, will be a lot more volatile than the first half. We got some bigger risks on the horizon, and markets are very complacent now.
Alberto, where do you see a boom economy outcome to see price up and yield down? I'm fascinated where you are in your head, Q3, Q4, even the first quarter of next year. How do you get there?
So, you know, in the first half of the year, especially Q1, the big news was the U.S. fiscal stimulus, the new administration deploying this firepower, not just to combat the virus, but also to create new growth. This news is gone. Now we have, yes, other governments spending like Europe, but it's much slower. And ahead of us, we have three big risks. The first one is central banks might withdraw the punch bowl. At some point, there's going to be a discussion of tapering from the Fed, and it could be in Q3, Q4 already. The second risk is geopolitics. Russia and China are teaming up against the US in Ukraine and in Taiwan. There's also a shortage of semiconductors. That's going to affect, you know, they're testing the Biden administration. This risk is not really priced in by markets. And then the third risk is that the vaccines are still going pretty slow in Europe and in a lot of emerging markets. You know, the economies, the non-US, non-UK economies are going to take a lot longer to reopen. So it's a really K-shaped recovery, and markets have been pricing a B-shaped recovery. So we're going to see more volatility in our view in Q3 and Q4. Today, we're at record low levels for credit spreads in high yield. In investment grade, we have the 100-year low wipeout buffer, the lowest yield level on US investment grade. So we're at really, really thin levels. Markets are priced for perfection. It's time to take a step back and focus on hedges and protection.
So hedges and protection, can you elaborate on what protection means at a time when there's fear of rising rates, of early withdrawal of monetary stimulus, as you were talking about, as well as are we priced to perfection on the riskier credit side?
We're almost priced to perfection. One of the protection that you want to have if you're fixed income investors, exactly prevent a declining price from a rise in rates, from a rise in inflation. And so far, treasuries were leading the widening, but we have seen also European bonds, bunds and BTPs have been widening more. And, the bar is much lower for Europe because everyone has been bearish. So for bunds to go to zero, for example, between now and year end, you just need a little bit of positive news, a bit of spending, and some agreements on the EU recovery fund. So that's going to drive bunds a little bit higher. It could wipe out all your carry if you have a very high duration. In credit, similarly, we have a lot of firms that have not restructured and are pretty levered, trading at really low spreads. US high yield spreads are close to 280 basis points. There is very little chance of making money during a cycle if you invest at that low level. At some point you're going to have a problem. So it's just a matter of when. So the question there is how to engineer strategies that hedge your portfolio or that have enough liquidity to buy when other people are selling. That's exactly what we're doing. You have to be a bit patient, but chasing the market now is foolish in fixed income. Bonds are very negatively convex for investors, but it doesn't mean you can't make money. You can make money when volatility comes back.
Here's the conundrum. That yes, this makes perfect sense based on historical investing principles. And yet every time that we see a sell-off in rates, if it gets a commensurate sell-off in credit, you get a flight to safety. That flight to safety is bonds. The yield goes lower and we get a reset of where we were before. Put on repeat, play it again. That is what we have seen. Why are we going into a new regime where that perhaps is not the cycle that we're going into?
There's two options for policymakers. One is to make the bond market reprice quickly. That would also entail higher funding costs for different treasuries around the world. Policymakers cannot afford that. So that's the second option, is to impose on investors a negative real return. So have inflation at 2.5% or 3% in the US, but interest rates at 1.5 to 2. And that's probably what's going to happen. So essentially bond investors, but that means also insurance companies and pension funds will lose money slowly instead of losing money quickly. It's a second best option, but it's still a very bad option. So as an active manager, essentially what we have to do is to trade these cycles, these policy cycles of widening in rates, which will not go back to a positive level against inflation.
You've also got to trade, Alberto, as well off of what ECB does. I guess there's a Lagarde message. Are you more interested in what she says, or are you more interested in what she does not say?
We're more interested in what she doesn't say. At the moment, there's not a lot of things the ECB can do. They're basically running on all cylinders. But the question is, when central bank digital currency, a lot of central banks have talked about this, and ultimately this is something that could unleash a lot more levers for monetary policy. For example, interest rates could become a lot more negative, or central banks could inject money to firms directly. So that's the ultimate frontier. It's not for today, it's not for this meeting, but it's a lot more interesting to hear what they don't say.
Alberto, we've got to leave it there. It's good to hear from you, sir. On football, of course, and a little bit on credit, the markets, and the ECB coming up tomorrow. Alberto, good to catch up. Alberto Gallo there, of Algebris Investments Portfolio Manager. Got to do a couple of things. Coming up on the programme on the Open in the next hour, Alpha Omega Advisor CEO and founder Peter Cecchini will be joining us. Peter Cecchini coming up a little bit later. Also got to promo this. $12.3 trillion in stimulus killed the default cycle. Here's the lead paragraph.
Oh, dear
It's
Lord.
fair to say that $12.3 trillion of stimulus seems to have killed off the US credit cycle. Almost all fear of bankruptcy has been obliterated from debt markets, even though the global economy is still struggling under the worst health crisis in a century. Do you recognise the author of this piece, Tom? On Bloomberg Opinion today, a column
is she any
from
good?
Lisa
Can we get her on air?
Abramowitz. We should get her on sometime, shouldn't we?
We should.
To have a rant about
Let's
a credit
try her,
market.
you know?
Lisa, I've had a read-through. Fantastic piece, and I suggest everyone else has a read-through too.
Well, thank you. Honestly, this is just something I've been thinking about, especially after Fitch Ratings put out their lowered forecast for defaults. This idea here that we've prolonged the debt cycle to make it resemble something we've never seen before in history, where there isn't necessarily the fiscal discipline. What is the outcome of this, right? I mean, if we don't get that debt default cycle, how do we emerge from this crisis? Do we become that much less efficient? What is the role in the central banking system going forward?
Basically, every time Tom talked about football this week, you just took the time to write a new paragraph. would that be a fair characterization of what happened this week?
It's all transitory.
I wrote an essay that it was finally time for the American League to get rid of the DH, and Tim O'Brien said we can't publish it.
There we go. Take a read of it. Great piece on the Bloomberg Opinion column today from Lisa Abramowitz. $12.3 trillion in stimulus, killing the default cycle. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Wednesday morning, equities lower, down 10 on the S&P. We are off by around about 0.25%. Into the bond market, where yields are unchanged at 156.26. Talked a little bit about the ECB and President Christine Lagarde's news conference. Tom, that will be your main event tomorrow morning.
Today, with the data the way it is at 9 o'clock, looks like a snooze fest.
Thank you, Tom, for the promo. Euro dollar 120.07. All friends on this program, aren't we?
Great.
On radio, on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden has called on Congress to honor George Floyd by passing law enforcement reform. Biden spoke after a jury convicted the former Minneapolis police officer Derek Chauvin of killing Floyd. House Democrats have passed legislation that imposes restrictions on federal authorities. In the Senate, the bill doesn't have a clear path to a filibuster-proof 60-vote majority. A U.S.-driven effort to reach an agreement on taxing big tech companies' overseas profits is getting bogged down. The reason is one company in particular, that is Amazon. The new rules would apply to any large companies that exceed certain numbers for their annual revenue and profit margin. But Amazon is a low-margin tech giant, and other countries are balking at the idea that could mean it wouldn't be covered by a tax agreement. And Verizon lost regular wireless subscribers for the first time in a year. The largest U.S. carrier posted a loss of 170,000 monthly wireless customers in the first quarter. Analysts had forecast an increase. It's a troubling sign for Verizon, which is trying to catch up with rivals AT&T and T-Mobile in the race for 5G subscribers. And prescription eyewear seller Warby Parker is considering an IPO, possibly this year. Bloomberg's learned the company is in talks with advisors. Warby Parker raised $120 million in its most recent funding round in 2020. That gave it a value of $3 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport industry
buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Reach the time at which we will taper asset purchases when we've made substantial further progress toward our goals from last December when we announced that guidance, and that would in all likelihood be well before the time we consider raising interest rates. We haven't voted on that order, but that is the sense of the guidance, is that it would work in that way.
The chairman of the Federal Reserve System, Jerome Powell, and that is a different Jerome Powell than when he was speaking early in his tenure. He has really grown into the conversation and the guidance forward. He gives guidance to David Rubenstein, peer-to-peer conversations. This is a piercing interview off of the Economic Club of Washington. Look for it tonight at 9 p.m. And Mr. Rubenstein joins us right now. David, what did you learn from Chairman Powell? He speaks a lot. He messages a lot. What was new in your conversation?
I think he made it very clear that interest rates are unlikely to go up until after 2022, but the standard really is whether inflation gets to 2% or above and be sustained at that level, and secondly, whether the unemployment rate goes down to what's called full employment. So if you get full employment, let's say 4% or 4.5%, inflation is at 2% and appears to be going above 2%, then I think he would look at an interest rate increase, but he does not anticipate that happening before 2022 is over.
David Rubenstein, the arc of your career from working for Carter Mondale years ago and also the development with Carlyle of the allocation of capital. In your conversation, did you speak about the distortions to our capital incentives by negative real yields?
Well, we didn't really talk about negative real yields because it just hasn't been something that they have really focused on. The Federal Reserve's view is that negative yields is not a really good thing to do. Now, we, in effect, have negative yields to some extent, but he's more focused on making certain the economy comes back to a full employment situation. That's his main focus. And I would say he's very confident in his position now. He's obviously been doing it for a while. I think he's got the confidence of the of the Federal Reserve Board, and I think he's got the confidence of the Secretary of Treasury, and I would say the President of the United States as well. I think he's done a very good job, and as we talked about, he doesn't talk in what I call Fed speak. He's not an economist, and therefore he talks like a normal human being, and that's a good thing.
Lisa, this is a hugely important deal. I really agree with David on that, and as I've said, Jerome Powell's really grown into being comfortable not doing Fed speak.
There is a question of whether it also highlights how the Federal Reserve has transformed from controlling the monetary system or sort of setting rates to a much more popular body, basically trying to speak to a broader mandate. And I think about the meaning behind full employment. Was that the message, David, that you got from Chair Powell?
He is not in an ivory tower. He's not an economist. He spends a lot more time up on Capitol Hill talking to members or talking with them on telephone than the normal Fed chairman does. He regards that as part of his job. His mandate is not to worry about climate change or to worry about minority unemployment, but they do consider those factors, I think, in an oblique way. And so I think he's much more sensitive to these issues than maybe some of his predecessors. In fact, he talked about in a prior interview and in this interview the fact that when he goes to the Fed every day, and he often bikes in, he drives past a kind of a homeless shelter or a set of homeless tents, and it affects him. And he obviously talks about it because he recognizes the impact of the economy has not been very good on many people in the lower part of the economic strata. And he does worry about that, even though it's not technically in his mandate.
He also weighed in on cryptocurrencies, and this comes as Coinbase went public, and he talked about them being a speculative asset. What's your sense of his view? I mean, do you think that that is the correct view right now, or is this a future, not the future, but a future of an entire investing class?
I would be surprised if it disappears. It seems to serve a purpose for some people, and I do think that it's likely to be around for a while. He did say that people aren't using it to pay bills and so forth, but actually in some places now I think you can actually use cryptocurrency to pay for certain things. It's a small part of the economy, but I think they're watching it, they're monitoring it. His main job is to make certain that the economy comes back in a reasonable way without a lot of inflation. And I think he's very, very attentive to it. Now, he did work at my firm for a number of years. I got to know him before he was in government, and I would say he's an incredibly hardworking, very articulate person. I think the fact that he has a close relationship with Janet Yellen is a plus.
David, I must digress in that you are familiar with the entrepreneurial spirit of the Glazer family of Rochester, New York, the acuity and financial wisdom of John Henry of the Fenway Group. All these people dabbled in English football. We have seen a complete debacle of people with a lot of money trying to impute a business plan on a culture in society. What is your observation of the collapse of this soccer league across Europe? What is your observation of how fancy guys got this so wrong?
Well, a lot of American entrepreneurs did make a fair amount of money investing in European soccer, typically British soccer teams. And a lot of people were surprised when the Glazer family originally bought Manchester United. It turned out to be a very good deal. And I think John Henry's investment turned out to be good, too. Whether the new effort will work or not, it's too early to say. But it is interesting how so many wealthy people today want to invest in sports franchises, not so much because they love the sport, because they think it's a good investment. You know, 100 years ago, or maybe 75 years ago, people often bought sports teams because they really loved the sport. And while I wouldn't say these people dislike the sport, it's basically an investment kind of process now.
David, it's a slow day. I got to make some news quick here. How much do you love the Baltimore Orioles right now?
Oh, my goodness.
Well, I did grow up in Baltimore, and I am a big fan of the Baltimore Orioles, and I am hopeful that they can live up to their glory days when I was a young person.
And
I'm sorry?
See how he stepped around that, Lisa.
Yeah, the headlines
David,
are just
I just think the entrepreneurial spirit you would bring to the Orioles into an American league, it would be wonderful.
Well, right now I'm focused on this interview on the Jay Powell, which is being broadcast tonight on Bloomberg TV. I spent an hour with him.
Well done.
And we've edited it down.
Well done.
And I would say that the producer on the show has done a wonderful job of editing it down. And I should say, Kelly, I want to congratulate her on just getting engaged this weekend. So thank you for for that and for all the good job you're doing in editing this interview down. I think look, if you want to see Jay Powell in kind of up close in person. This is a good way to do it because he really does open up. He's fairly frank, and I would say I have a good relationship with him, and I think he was fairly open about it.
David, thank you so much for mentioning that, and of course what Kelly's been doing for you on all these interviews from Jeff Bezos and on as well. David Rubenstein with Jerome Powell, and as Mr. Rubenstein mentions, it is a piercing and different interview than the usual that you hear from Jerome Powell tonight. Lisa?
Tom, there is actually news crossing the Bloomberg terminal that IATA, that's the International Air Transport Association, sees the expectation for airlines to start breaking even in 2022, which is interesting given the fact that international travel has to come back by then. When in 2022 is important, though, Tom.
Key idea there is to get out to 2022. We've heard that from executives of domestic airlines as well. Coming up, Jana Harmon. Lots to talk about here on America, and particularly on Washington. This is Bloomberg Radio and Television.
Is there anything you think the Fed should be able to do to help people who are really suffering in the pandemic?
I think they need to be in the room with us as we make our decisions about monetary policy.
Big tech such as Alibaba and Tencent are no doubt national champions, but now China is stepping up oversight. Just how far will the Chinese government go on regulation? We'll explore on a Bloomberg special, Red Lines, China and Big Tech.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our audience worldwide, good morning, good morning. This is the Countdown to the Open. The Countdown to the Open starts right now. 30 minutes away from the opening bell with equity futures slightly negative, down 0.2%. We begin with a big issue, the cyclical rally stalling.
We're going into this period where, the news is kind of baked in the short term.
This dry up in volume, sort of confusion in leadership, very much in what you called this exhaustion phase.
This idea that the sort of second derivative of economic growth is, the growth of the growth is peaking.
We had the big reopening trade initially.
Saw a huge rotation go into cyclicals and small caps.
Saw 10-year yields go from 0.5% to 1.75%.
The likely outcome is a pause.
Pause in the reopening trade.
Small caps have started to underperform.
We're only pausing.
We continue to like the reflationary stories.
What happens in 2022? What happens when we have reopened?
What we don't like as much anymore are the reopening plays.
We don't like to chase the market.
At this stage in the cycle, we're really at an inflection point.
That's, I think, what the market is struggling with a little bit now.
There is a little bit of a struggle right now. Let's bring in the Bloomberg team, Kelly Lyons and Michael McKee. Good morning, Kelly.
Good morning, John. Well, we've taken a little bit of a breather in the broader equity market over the last 2 days, but it is the cyclical trade that has gotten hit the hardest. Yes, all the major benchmarks are down, but by 1.7% or less on the S&P 500, the Dow, and the NASDAQ, while the Russell 2000 is down by more than 3% in just the last 2 sessions. After rallying 20% from the start of the year to mid-March, that small cap index is now down about 7% from mid-March to now. There was so much enthusiasm in the small cap space as we came into 2021 on expectations of better economic growth and reopening, but that is starting to cool down. And we've seen a cooling down really in the broader... Okay, guys, it's time to move my stop on profit for British pound in our advantage to 139 over 21.3. We'll put 21.3. Okay, so if you follow the trade, please do so. Please place stop on profit higher. It means if we trade short, it will be lower in case, and this way you will end up in profit. In our case, it will be 10 pips. In your case, it will be 10 pips. In our case, it will be £1,000, and in your case, it will be all about how much broker pays you per pip. Okay? That's it. This is all I wanted to tell you, and I'll speak to you later. Stay safe.
Market small caps, we've talked about that so many times. The middle of March for when small caps topped out. For airlines, 10 straight days of losses for the airlines. 10 straight days, which amount to about a loss of 11.5%. And this headline comes from IATA right now, seeing up to $48 billion of losses for the industry in this year for 2021. That's a 2-week chart for you on the screen right now for the airlines index. Mike McKee, I think the airlines right now really capturing the struggle, not here domestically in America, but the struggle internationally.
Yeah, there's no business travel, and tourism is difficult. The U.S. talking about something like 80 countries on a no-fly list for the summer when airlines thought things were going to get better, because the rest of the world is not getting better. Things look good in the United States. We're seeing case counts fall. But when you look around the rest of the world, you look at places like Brazil and the Philippines, even India is really, really bad right now. Markets falling in all of those areas. And you can see this report from the World Health Organization, 8 consecutive weeks of rising cases around the world, 3 million deaths, the 5th consecutive week. And look at how we are accelerating the number of deaths. 3 months to reach 3 million deaths. It took us 9 months to get to 1 million. The concern is, of course, that as more cases pop up in unvaccinated areas, we could get possible variants that then come in and overwhelm the vaccines that we have. And we're still not doing a good job of vaccinating the rest of the world. Who's getting vaccinated? Well, Israel and the United States sort of top the list. We know that, along with the UK. But there are 83 countries where the vaccination rate is 0.5% or less. What can be done? Well, there's talk of donating vaccines to some of these markets, but the question is when. The U.S. is only, well, we're less than 50% vaccinated right now, and Europe is much lower. The Trump administration put limits on the possibilities of donating. There are contracts with the manufacturers. And then there's something called the trade-related aspects of intellectual property rights. It's a way to waive the fees that these countries would have to pay. The Trump administration blocked it. Biden administration's thinking about changing it, but they're not there yet.
Mike, there's some work to do, that's for sure. Michael McKee, thank you. Peter Cicchini of Axonic Capital raising concerns about the cyclical trade at the end of March, writing the following: perhaps the latest round of stimulus will keep the cyclicals trade alive a bit longer, but I just don't see the cycle turning for good. Staying tactical and nimble seems prudent now. I would begin unwinding the energy and commodities cyclical trade. Peter joins us now for more. Pete, many people have done exactly that, and they've been doing it for a while. Big debate right now is a simple one. Is this a pause or the start of a longer term, perhaps more sinister reversal? Which one, Pete?
Well, obviously not an easy assessment. I read Lisa's article on the $12 trillion plus global stimulus.
Great piece.
It was a great piece. The question really is, has that eliminated the default cycle or simply delayed it? We've had $5 trillion in stimulus here in the U.S. from a fiscal policy perspective. I do believe, as you know, we're probably going to get some inflation from that. That will impact the yield curve. We'll probably see, 10-year yields bottoming at, let's call it 150, but with risk to 2 to 2.25. All of that makes it difficult to continue to like cyclicals in particular. And I'm concerned that as the stimulus sort of wears off in the second half of the year, that the very optimistic expectations for the reopening are going to be met with some tears.
Pete, just a couple of questions. You talked about that move back towards 2% and how that wouldn't be good for the cyclical trade. It was in Q1. What would be different about the rest of the year?
Well, look, we saw it yesterday a little bit. We saw 10-year yields falling a touch. I think we're at about 156 right now. That was obviously good for interest rate sensitive equities like REITs, like utilities. But overall, when you get to a level like 2 or 2.25%, should we get there, I think that will be bad for risk assets in general, and that the rotation that rates has been creating, whether they go lower or higher, will end up being a correlation lower for risk assets at higher yields. And then, of course, what happens reflexively once yields get to that level and there's a risk off, as Lisa mentioned earlier today, once again, then we see lower yields on the risk off.
Pete, you and I are talking about fundamentals. You're also keeping your eye on flows, and I think that's important. Flows and retail flows as well. Pete, how important is that dynamic at the moment?
Look, I think, unfortunately, I think it's most of the dynamic right now. Valuation has not mattered for some time. You and I have spoken about it. I've written extensively about it. It's fallen on deaf ears, I guess, for most people. But the S&P is trading at 3.5 times revenue right now, which is, and even on a forward basis, looking at 2021 consensus earnings, we're above the valuation levels that we saw in 2000. The counter argument to that, of course, that people make is, well, interest rates are so very low. Well, let's contrast that. In 2016, when we saw the 10-year at about 1.4, 1.5% near its low, the S&P was trading at about 2.5 times revenue. So it's not an interest rate phenomenon. Interest rates are low and yields are low for a reason. That is, structural growth has been lower and lower over time, and that's why interest rates have stayed lower and lower over time. Cash flows have not improved significantly on a longer-term trend basis. In fact, earnings for corporations in the United States actually peaked in 2014, believe it or not. So, I'm very concerned that once the flows abate a little bit, as people work from home less and frankly gamble less in the markets, that the markets will be challenged from that flow perspective, which I'm convinced for some time and have been for some time, that's what's buoying equity valuations.
Pete, forgive me if I sound somewhat flippant. Forgive me. Just indulge me a little bit. In the last 5 minutes, you've talked about high yields being bad for equities, also talked about lower yields being a reflection of a bad environment, which is also bad for equities. I'm trying to understand what makes Peter Cicchini bullish right now. What is it, Pete?
Yeah. Well, look, I've been pretty tactical. I liked, as you mentioned earlier in the lead-in, I did like the energy and commodity cyclical trade for much of this year. And I did think that flows would buoy the equity markets and, continue to inflate what I consider a valuation bubble. Right now, there isn't a heck of a lot that makes me bullish on U.S. equities. There are other asset classes I do like. I like cash flowing real estate assets, which is something that we do very well here at Exonic. But relative to equities, I think they are as extravagantly priced as I've certainly seen them in my career.
Pete, always good to catch up. Peter Cicchini there of Exonic. Also, got a promo. My good friend and colleague Lisa Abramovic's column today. $12.3 trillion in stimulus killed the default cycle. You can find that on Bloomberg Opinion, on Bloomberg.com, and on the Bloomberg terminal. Let's turn now to the price action of this morning and get you some movers at the market desk. Here's Abby.
Well, John, we are, of course, right now looking at a third down day for stocks. The first time we've seen that in quite some time. And the NASDAQ 100 futures are down more than the S&P 500. This, of course, has everything to do with Netflix. Netflix really weighing on the S&P 500 and more so on the NASDAQ 100. The stock plunging after the company put up a hugely disappointing first quarter. Their streaming paid net change missed estimates. Last year's record quarter and all of the growth around the pandemic really setting a high bar here. As a result, they put up the worst first quarter in 8 years. Plus, it really points the fact that they missed their own forecast points to the fact that there's lots of uncertainty, that they don't have a lot of believable visibility. So Netflix really weighing today. That's also weighing at the other stay-at-home stocks, such as Roku, Grubhub, Peloton, Zoom. Folks worried that the stay-at-home trend is coming to an end, which of course is a positive over the long term, but right now hitting these stocks. The reopening trade, though, as you've been talking about, cooling off a little bit, John, especially those airlines now down for an 11th day in a row if the stocks open the way that they are positioned right now, which is down. Yeah, unreal. And in an industry association, as you know, saying that this year's loss could now be $48 billion as opposed to the earlier estimated $38 billion. Tough stuff.
Abby, tough stuff indeed. Looking forward to the coverage through the next 60 minutes or so. Coming up, vaccination efforts in Europe gaining momentum. The pace of inoculations rapidly improving. That conversation up next with Zach Pandel of Goldman Sachs. 20 minutes out from the opening bell. Equities down just a touch. No drama. Down 0.2% on the S&P, off 8 or 9 points. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Majority of scientific opinion in this country is still firmly of the view that there will be another wave of COVID at some stage this year. And so we must, as far as possible, learn to live with this disease as we live with other diseases.
British Prime Minister Boris Johnson hoping to live with a potential surge in virus cases. This as the EU starts turning a corner on vaccinations. Germany leading the effort, doubling the pace of inoculations, with France and Spain following suit. I'm going to bring in Bloomberg's Guy Johnson from London for more. Guy, quite clearly Europe's turned a corner. India is just tragic. Brazil's been struggling now for months and much of the last year. There's nothing synchronized about this right now, is there, Guy?
Absolutely not, but it was always going to be the case that developed world markets were likely to get access to the vaccine first. We have seen Europe make many a misstep in terms of this process, but as you say, finally starting to gain traction. You and I talked about this about 2 weeks ago. We've certainly seen the pickup in the pace ever since then. But you have to remember as well, John, that Europe is still in lockdown. There is a bill going through the lower house of the German parliament today, the Bundestag, which basically centralizes power in Berlin with Angela Merkel to make sure that she can get a grip on what is happening inside her country. The French are still in a heavy lockdown as well. But the music has changed. The pace of the pickup in the vaccinations has started to improve things. I'm waiting to start to see whether or not we see a tone in terms of the official language. Christine Lagarde tomorrow, is she going to reflect this? We'll wait and see. Are we going to see an upgrade in terms of the expectations for the European numbers as we work our way through this year? When will this start to have an impact? We know that the vaccinations are happening, but we look at what's happened in the UK. It's taken a while to get the situation to a point at which you can start reopening the economy in the irreversible way that Boris Johnson wants, John. So we are seeing progress, but there is still some way to go. And Boris Johnson talks about that next wave. People are talking about another, and they're calling it an exit wave, maybe later on this year, John. Yeah. And the other thing to note as well is that France and the rest of Europe still is really going to rely on the Astra jab and the J&J jab, and they need to convince people to get it. In fact, France is in negotiation with TV companies to get live coverage of famous people in France getting their shots.
Guy, just before we let you go, you're my man on the airlines. It's a struggle here in the States at the moment. 10, maybe 11 straight days of losses for the airlines index. What's going on with travel? You and I caught up with Michael O'Leary of Ryanair a number of weeks ago. He was talking about travel coming back in Europe in the summer. What's that call look like now?
I think it's looking really, really tough. And to your point about the United States, and I've heard you talk about it, I think we've reached the point where domestic travel has reopened, but international travel looks really hard, John. And that's the kind of the next leg in the reopening trade that needs to happen for these airlines really to get their balance sheets back in order. That's where they make a lot of the money, and it's a similar story over here in Europe. The low-cost carriers probably will have an okay-ish summer. I think kind of people are talking about 50% capacity. That may even be too optimistic, but the long-haul reopening still looks very, very tough right now. Maybe we get the North Atlantic reopened, but as you pointed out, India, that's going to make life very difficult. I talked to Tim Clark this morning from Emirates, and that's a key factor in terms of his business going forward.
Looking forward to the coverage with Alex Steele at the top of the hour, Guy, in about 40 minutes' time. Goldman Sachs Pandal expecting European asset prices to benefit from rising inoculations. He writes the following: as peak growth moves from forecast to fact, we see more upside to European growth pricing. Continental Europe is turning a corner, and we now expect the vaccine-led boost to asset prices we saw in the United States to broaden to Europe too. Zach joins us now for more. Zach, can we just get to the FX call off the back of this too? What this means through the FX channel, what you'd look for from the single currency in Europe?
Absolutely. So at the start of this year, the euro, other currencies depreciated versus the US dollar as the US was out in front in terms of its vaccination speed, and as the markets significantly repriced the expected path for Fed tightening. Now that is changing. Europe is likely to see accelerating vaccinations. Fed pricing has begun to stabilize, and therefore we think the dollar can begin to turn lower again, especially versus the single currency. So we're moved up our forecast for the euro-dollar cross to 125 from 121 for the 3-month target, sticking with 128 for our 12-month target, and we issued a new long recommendation over the weekend.
Zach, do you think that's something that's supported by rate differentials, flows, or both?
Potentially both. You know, your U.S. rates have begun to stabilize. 5-year Treasury note yields basically flat over the last month, despite booming growth, booming inflation data. That might tell us that we've built in enough risk premia around the front end of the curve that Fed pricing will be at least stable going forward, and front-end rate volatility can come down. On the other hand, the ECB is probably going to be moving towards some policy normalization steps over the next few months. not at this week's meeting, but we think at the June ECB meeting, they will announce a step down of the pace of asset purchases. So we think European rates have more upside versus the U.S. at the moment, so that tightening of rate differentials can also support the euro.
Just in terms of central bank acceptance, you're making a really important point here, Zach. When we saw the move higher in Treasury yields, there was a belief at the Fed, a view, and they expressed it, that it was consistent with an improving outlook. Are you expecting the same thing to happen in Europe then, that they'll allow that to happen, almost encourage it by stepping back bond buying?
Well, the ECB is not ready to certainly to encourage a tightening of financial conditions. What we heard from Christine Lagarde at their last meeting was that at that time it was premature to allow a tightening of financial conditions given the very early state of the recovery and the fact that the vaccination campaign had a long way to go. But fast forward to June, by the end of June, we think the euro area will be more than 50% vaccinated. So at that time, we think the ECB will be able to look at its bond buying program, look at the extent of the recovery, and make some new decisions at that time. So it was premature last month, probably premature now, certainly, to talk about tightening of policy. But come by the June meeting or shortly thereafter, we think that those discussions can significantly pick up, and we think that we'll get the announcement at the June ECB meeting.
Yeah, Zach, forgive me. I don't think they'll intentionally encourage it. I just wonder whether they do that by accident. There's been a lot of confusion around this front-loading of bond buying this quarter at the ECB. Zach, I don't see it in the data. What's your read on that going into the meeting tomorrow?
Well, we do think that they've stepped up the pace of purchases. They're difficult to measure, partly because of redemptions and things like that. I think Christine Lagarde will say that they are comfortable with the decision that they made at the last meeting to step up the pace of bond purchases. They want to see broadly easy financial conditions to encourage the recovery over the next few months. But I think she'll also express some confidence that the recovery fund issuance is going to be picking up, that vaccinations are beginning to accelerate. So it's too soon, of course, to say that Europe is fully out of its current lockdown situation. That's going to take a little bit of time, but we're seeing early signs of that to begin to improve, faster vaccinations, COVID case numbers coming down in a few places. I think you'll hear some of that confidence from Lagarde on Thursday.
Zach, just a final question for me. If you can put on your EM hat for the final question, that would be great. As we turn from the euro and this pro-cyclical enthusiasm that we could see on the continent, do you see that extending to emerging markets? On the equity side, this really topped out in the middle of February. Can we start to get a lift on the FX side?
I think we can. It might be a little bit more backloaded compared to the euro. Right now, I think the main opportunity really is euro-dollar strength driven by developments in continental Europe. But emerging markets are going to see some of this same benefit as well later in the year, and generally they're supported by rising global growth, rising commodity prices. So I think more tailwinds than headwinds for emerging market currencies, although we would prefer to express the view in euro now and maybe emerging market currencies, a couple of months down the road.
Interesting, Zach. Well, I hope we can catch up before then. It's good to see you. Zach Pandal there of Goldman Sachs on this FX market and the situation specifically in Europe going into that ECB news conference with President Christine Lagarde and that decision from the Governing Council tomorrow. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, it is the stock mover of the morning. Netflix plunging after its pandemic-fueled boom with the stay-at-home stocks under pressure. We had the boom. Now it's the give back. That conversation still ahead with Citigroup's Kristen Bitterly and Tom Sitsouris of Strategas.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Five minutes away from the opening bell in New York City. Good morning to you all. Going into the cash open, we're down about 9 points on the S&P 500, off by about 0.2% at 41.18. 2 days of losses could become 3. Time now for the morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, a call from UBS upgrading PepsiCo to a buy. 165 price target. The analyst expecting recent investments to fuel upside to upcoming earnings and revenue growth. We're positive there by a little more than 0.8%. Your second call from Bank of America, downgrading AutoZone to underperform, 13.90 price target. The analyst cited concerns over valuation following the stock's recent rally. And finally, Stifel, upgrading Netflix to a buy, 5.60 price target. The analyst recommending investors take advantage of the pullback due to the company's compelling growth potential. We're down hard here this morning. We're off by 8% on Netflix stock. Coming up, more on those Netflix results. A big subscriber miss following last year's pandemic boom. That conversation up next with Citigroup's Tristan Bidley and Tom Tsouras of Strategas. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
This is really an extraordinary moment, I think, in terms of thinking about cures for genetic disorders.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
"25 seconds away from the opening bell in New York City this morning. Good morning. 2 straight days of losses, set to become 3, at least at the opening bell. It's a mild move lower on the S&P 500 by a little more than 0.1%. We're flat on the Russell after 2 big days of losses. On the Nasdaq, we're down about 1/3 of 1%. There's your opening bell. Switch on the board into the bond market. Going into the ECB tomorrow. Yields stable. South of 160 at 157. Let's call it 157. Up about a basis point on the day. Euro dollar clinging to a 120 handle. Going into Christine Lagarde tomorrow. 120.04 and down about 1/3 of 1%. Crude. I think crude had a 64 handle in yesterday's session at one point. 61.20 right now and down a little more than 2%. That's the cross-asset story this Wednesday. At the market desk with your movers around the opening bell. Is Abby.
Hi, John. Well, let's start out with this morning's big stock story, and that, of course, is Netflix. Shares are plunging here in the morning, right now having their worst day since November 9th of last year, slicing below the 200-day moving average. This stock is now negative on the year, and they, of course, put up a disappointing quarter, missing sub-estimates, plus The View. They're estimating for the current quarter just adding 1 million new customers versus the estimate of 4.4 million. It's very clear that they have a complete lack of visibility coming out of this pandemic, not knowing how many customers will be staying home to watch their programming at this point, really weighing again on the stock, negative on the year. It's also weighing on some of the other media and streaming related companies such as Viacom, Discovery. Those two, of course, are also some of the stocks involved in the Archegos blow up. But today we're looking at fallout from the poor Netflix quarter. Roku down sharply too, down 4%. And then finally rounding it out with some of the heavyweights, one of the reasons that we've had stocks down 3 days in a row, Apple, Alphabet, and Spotify. These three companies are down. Apple and Alphabet not quite as much as earlier, but they, of course, now are going to be facing a bipartisan grilling on Capitol Hill. And then Tesla, some drama happening in China at their Shanghai Auto Show. One customer stomping on the top of one of their cars, saying that the brakes didn't work. Tesla has apologized. That stock down 1.7%. Definitely not the optics that Tesla wants.
And not good optics at all. Bit of a PR issue there. Abby, thank you. About 2 minutes into the session, your S&P 500 off by a mere 1/10 of 1%. A third straight day of losses. Energy, bottom of the pile, off by 1.2%. Top of the pile, consumer staples up by about 0.6 of 1% this morning. That's the story in the early part of this session. Let's get to that quote from Reed Hastings, shall we? The executive chairman and co-chief executive officer over at Netflix. Listen to this. We had those 10 years where we were growing smooth as silk. It's a little wobbly right now. It is for sure. Take a look at the stock in the early part of today's session. Let's head to the West Coast, San Francisco. Bloomberg's Ed Ludlow has more. Morning, Ed.
Good morning. Yeah, if you want one example of COVID-19 pull forward, Netflix is it, right? Come with me into my Bloomberg and look at this chart, because a picture tells 1,000 words. Look at the first quarter of 2020 and look at the most recent quarter that we got last night. All of that growth coming in 2020 suddenly ground to a halt in the first 3 months of this year. It's something that Netflix telegraphed. They've been talking about this for 3 consecutive quarters. It's just that growth slowed down much more dramatically than anyone was expected. What does Netflix blame it on? They say that consumers are coming out of their COVID hibernation. They say essentially as well that there was a content deficit. The pandemic shut down their ability to produce new content, which in turn left nothing to attract new users to the platform in the first 3 months of the year. Look, it's ironic almost, because Netflix is in the strongest financial position it's been in the company's history. It's just that it's become this barometer for the stay-at-home stocks. And if you look at that basket of companies, which, as Abigail points out, Netflix is now negative year to date, along with several others like Peloton, like Zoom. The thing is, it's amazing how closely those stocks are tied to a vaccine rollout. There's one piece of evidence that I would put forward to you on that. April 13th, when the Johnson & Johnson vaccine was put on pause by regulators, that was the basket of stocks that rose. And it's interesting to see how closely investors tie the fate of those stocks to how long we're going to be stuck working from home, learning from home as well. But if you read across the Wall Street notes on Wednesday morning, actually, a lot of them are giving Netflix the benefit of the doubt. They're saying that this is dramatic, but it's a blip, and they point to that content deficit that I was talking about. They plan to spend $17 billion this year on content, which should materialize in the second half. They really played down the effects of competition from the likes of Disney and Paramount Plus, and they're confident that those subscribers will return in the second half of 2021, John.
I see that from Stifel this morning with the upgrade to a buy and a 560 price target from the team over there. Exactly what you're just saying. Ed, just finally from me, competition. They had an interesting response to this issue. What was the response?
Yeah, the response was, well, Our slowdown in growth is in global markets. Our competitors do not operate in those global markets. There was a lot of discussion about pricing, which we expected. Netflix is more expensive than the offerings of some of its competitors. Its response to that was, those are promotional prices. And that's that chart I was talking about there. Look at basically the highest bar. That's the first quarter of 2020. That's the pull forward that I was talking about. The difference in the first 3 months of this year is that competition that's come online. There is third-party data that suggests Netflix lost market share. But their point is that their biggest rival is not those streaming platforms, it's linear TV, and actually people are just simply leaving their homes. The world is changing, the vaccine is rolling out, it's time to go back to normal, John.
Some people reclaiming their lives in places like America where the vaccination effort has been so good. Ed, it's good to see you. Ed Ludlow there. Let's bring in Citi's Kristen Bidley and Tom Tsouras of Strategas as well. For the equity, this was bad news. For the credit, we've seen some great news for Netflix over the last year, and that's the conversation I want to have right now. Kristen, on the equity side of things, a ton of pull forward for some of these companies last year. Is it the give back, the payback year this year?
I'm not sure it's necessarily the give back payback, but I think a really important element of this is earnings and looking at these releases, right? And we said this going into earnings season. You had the COVID defensives, you had the COVID cyclicals. We saw that massive rotation in March with value, kind of the leave your home, right? Stocks massively outperforming, the best outperformance we've seen in over a decade. And I think what the market is grappling with right now, which is why these earnings announcements and forward guidance are so important, is they're looking and saying, okay, yes, there is that mean reversion, there is that catch-up trade, tech-dominated, e-commerce, services dominated last year. But within these sectors, who are going to be the winners and losers? So just like COVID was an exogenous shock that impacted every asset price on the face of the planet, what was the benefit of COVID and what is actually here to stay, or what is actually at risk? And so that's some of the price action that we're seeing and really trying to interpret Netflix's earnings.
Tom, I want to bring you into the conversation on the credit side of things, just how much stronger credit is over the last 12 years. It was bad, really bad, and now arguably it's less bad. The likes of Netflix, one notch from investment grade, and I think Moody's. Tom, your take on that in the last 12 months, how much stronger is the credit market in America?
Yeah. Well, this has been a Goldilocks convergence of great scenarios for the credit markets. And there's one number that really sums this up, and that is free cash flow. That is, you've got enormous amount of stimulus coming from the federal government. Much of that is going into consumer wallets and spending there, and that's finding its way into company balance sheets. You've also got lower borrowing costs, so you've seen companies refinancing. All of this translates into a very strong and stable free cash flow profile across the credit space. And as long as nominal growth doesn't become unanchored up or down, then you're still in a Goldilocks. Now, we do think nominal growth will eventually accelerate, and that will pose a threat to some companies and some credits.
Hey, Kristen, would you characterize this as a Goldilocks moment?
A Goldilocks moment? Yes, I think to a certain extent, right? When we think about the economic recovery, I think there's two things that investors are struggling with. One, the economic data is quite positive, right, and quite strong. And we actually believe that we're at the beginning stage of an economic recovery. That being said, from an asset price standpoint, looking at levels of the S&P 500, looking at credit spreads being as tight as they are, it becomes very difficult to navigate these markets and actually confidently invest. So while as we see that improving economic data, yes, very positive moment, and we believe that that's going to continue, but we're expecting some market volatility because this is something that we're starting to see some cracks, right? We're starting to see some elements of, and I guess, John, you could actually just call it a normal market, right? When you start to see these pullbacks of 5%. That's common in a normalized equity market.
Yeah, and we're seeing it in a cyclical trades. I mean, we've gone through this so many times. Mid caps, small caps rather, stalling out in the middle of March. 10-year yields stalling out at the end of March. Tom, do you get the feel this cyclical trade is just stalling or whether it's reversing? Which one is it for you?
I think it's just stalling. And I'll speak more specifically to the one broad measure of the cyclical trade, 10-year Treasury yields.
Yep.
I think we just got deeply oversold with some shorts really off sides at the end of March. And it didn't take much buying from foreign buyers to step in and kind of arrest the run up in yields. And then that caused a bit of a short covering. But the cyclical move is still in play here because the U.S. economy is reopening. You've got a global economy that's also following up behind the U.S., and you have additional stimulus which continue to be in the pipeline and potentially more stimulus. So 2021 is going to continue to be a cyclical story. I think we're just in a pause from what was an overbought conditions on cyclical equities and slightly oversold conditions on treasuries.
Tom, Kristen, you'll be sticking with us. We've got to talk about this inflation story in America as well. I want to head back to the market desk and get some movers. Here's Abby.
We've got another place, another segment of the market, John, to take a look at with cracks. And that, of course, is the Bitcoin space, because Bitcoin continues to be under pressure, now down about 11% from its all-time highs, below that 50-day moving average. That is a fancy way of saying that the near-term buyers are regretting having bought where they did, and you could see Bitcoin come in more. JP Morgan is concerned, warning of weakness, and Scott Minerd of Guggenheim recently said that he thinks Bitcoin could drop by more than 50%. Technically, it is weak, so you see lots of those names down in a big way after big declines recently. Again, Coinbase Global, Coinbase's direct listing last week, perhaps that was a sign of the times, sell the news event. Turning to some brighter news, though, Edwards Lifescience, the cardio company, is popping higher, up 4.8%. They put up a very strong quarter. They also boosted the full year. The street's very positive, taking up price targets across the street. And Intuitive Surgical, also very strong. The surgical systems company beat earnings by 33%, not a small number either, $3.50 on $1.3 billion, also a beat. For the first time ever, John, we have Intuitive Surgical trading above a $100 billion market cap, as you would imagine, a record high.
Abby, thank you. Thank you very much. Coming up, prices heading higher. A growing list of companies ready to pass on higher costs. We'll have that conversation with Kristen Bitterly and Tom Titsouras from New York City. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive.
but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
We'll get a lot of inflation in the second half of the year, and then into 2022, just ask Procter & Gamble, Coca-Cola, Home Depot, etc. Then the mega caps, they have the profit margins to really be aggressive and keep prices low and gain more market share against weaker players in the industry. So I think mega caps will be an excellent inflation play as well.
A growing list of companies, retailers passing on higher prices to consumers as cost pressures build. The Coca-Cola CFO expecting an inflation pickup in 2022, saying the following: "We think it's manageable this year. It's really a challenge for next year." For more, let's bring in Bloomberg's Kaylee Lines. Hey, Kaylee.
Hey, John. Well, it's not just Coca-Cola. Procter & Gamble yesterday raising prices on a number of goods due to higher commodity costs. And of course, it's not just Procter & Gamble and Coca-Cola. As you said, a growing list of companies, specifically in the consumer goods sector, are facing this problem. And that is one of the reasons why consumer staples is the big underperformer within the S&P 500 on a year-to-date basis. That sector only up about 3%, lagging the broader market as it is more sensitive to inflation. While on the other side of the coin, energy is up 24%. Boosted by those higher commodity prices. And just to be clear on what I mean by higher prices, we have seen a massive move in some of these cyclical commodities. Lumber futures up 78% so far in 2021, and April isn't even over yet. Hogs, gasoline, tin, all up by 30% or more over the same period. And what all of that equates to is higher input costs. That could translate into margin pressure for these companies if they are unsuccessful in pushing those costs onto the consumers. That's one part of the equation, that corporate profit story. The other part is what happens if they are successful in pushing those costs on, and that is broader inflation. To this point, the boom we've seen in commodity prices has not tracked with consumer price inflation. It is far exceeding it. But if, John, companies are successful in exercising that pricing power, that is where we could see CPI starting to pick up, John.
Kelly, thank you. It's a theme that's emerging. We've heard it from Kimberly-Clark, we've heard it from Procter & Gamble, we've heard it from Coca-Cola. Let's have that conversation right now with Kristen Bidley of Citigroup and Tom Titsouris of Strategas. Tom, I want to start with you, just on the fixed income side. How closely you're watching this play out in corporate earnings?
Yeah, well, very closely. And really what the feedback from corporate CEOs is telling us is that they believe they have pricing power. That is, they look at the consumer pipeline and they see the price pressures on their producer side, on their corporate side, and they're saying, look, we think we finally have some pricing power. And that confidence in and of itself is a direct change from what we've seen in the last decade. So that's very important. And we look to those comments because that confidence is very important to us.
Kristen, are you focused on the same thing? Because we've had many people come on this program recently say, pricing power, pricing power, pricing power. We want a position for those companies. Are you doing the same?
Absolutely. And this is why we're looking very, very closely at earnings and fundamentals. This whole discussion around input pricing and the ability to then basically give that to the consumer, right? So to be able to pull that out to the consumer, we haven't seen that yet in terms of pricing power. But given all of the concerns around inflation, that's really what we're expecting in the second half of the year. And then it goes back to, from a portfolio positioning standpoint, where do you invest if you're worried about those rising costs ultimately?
Where do you invest, though, Kristen? Just give me some details where you would go.
So what we're doing, yeah, absolutely. So this is where it's really tricky, right? Because it's not like there's a great place to hide within fixed income markets, within equity markets at the current level. So one of the areas that we've been looking at are those areas that, both from a valuation standpoint, free cash flow generation standpoint, that are actually quite positive in this market. So we're looking outside the US, and there's markets, for example, like the UK, like the Eurozone, where you don't have that mean reversion priced in, you don't have that COVID recovery. From a PE multiple standpoint, actually quite attractive. And from a dividend yield standpoint, you're looking at about 3 to 4% in some of these, with some of these companies and in some of these regions. So when you're trying to bridge that gap, when duration can be punitive, when cash can be punitive in an inflationary environment, we're actually looking outside the US at those high free cash flow generating, high dividend paying companies.
Tom, Kristen going through the equity side of things, doing a wonderful job of exactly that. Can you walk me through the fixed income side of things, how you would express this through fixed income right now?
Yeah, there's not a lot of places to hide in fixed income if you're looking at a rise in inflation. The best you can do is kind of hope to, we'll call it clip your coupon, and avoid any sort of further selling or losses from duration risk. So that means you got to shorten your duration, move down the curve on investment grade. We still like, and we've always liked short duration investment grade corporates. We'll say an A- rated 2-year to 3-year piece of paper still performs reasonably well in that environment. But you got to supplement that with a little bit of lower quality credit, but you can't take on too much duration. So what that means is bank loans, leveraged loans. And now we go back to an earlier point I made about this being close to a Goldilocks credit environment. And I don't want to overstate that, because there's always risk on the horizon. But nonetheless, bank loans should, from a credit standpoint, should also perform well in this environment. And you also have rising rate exposure because of floating rate exposure there.
Tom, it's good to catch up. It's good to see you. Tom Tsouras there of Strategas, and Kristin Bidley. Kristin, thank you. Joining us from Citigroup. Let's get you some sector price action. This equity market turning a little bit lower over the last couple of days. Here's Abby.
Turning a little bit lower over the last couple of days, but in the last minute or two, John, turning just slightly higher, and that has everything to do with the mega cap tech sectors. If we go into the Bloomberg terminal and take a look at what's happening, moments ago, most sectors were red. Now we have most sectors green. So traders are really jockeying for position here, trying to bring stocks higher by the dip that we have had over the last couple of days. The top sector at this point, materials, followed by consumer staples, both of those, healthcare, excuse me, then consumer staples, all of those sectors up by more than 0.5%. But I was mentioning the mega caps. Not so long ago, you had tech and consumer discretionary, about 40% of the weight in the S&P 500, down, now up ever so slightly, off-weighing or offsetting, I should say, the weakness that you see there for communication services. And that, of course, is all about Netflix. That sector down 1%, Netflix down a lot more. But it seems like the bulls are out today, John.
Netflix down about 7.5%. The bulls aren't out there, that's for sure. Abigail, thank you. The company talking about pull forward, the acceleration through 2020, taking away some of the growth maybe from 2021. Those of you thinking about competition, the company pointing you towards the fact that this slowdown was also international, where there isn't as much competition there, if any, compared to, say, the United States of America. So declining there by a little more than 7% on Netflix this morning. Elsewhere for your broader equity market, let's run through the boards for you. On the S&P 500, we're shaping up as follows on the S&P. We're down around about 0.1% on the NASDAQ. On the S&P, we're up around about 0.2%. If you switch up the board and get to the bond market, this is what we look like for treasuries. Yields unchanged at 155.38 going into the ECB tomorrow. Big turnaround on crude from the highs of yesterday's session, in and around 64 to about 61.76 right now, and down another 1.5%. Euro dollar, the one to watch tomorrow, 120.10 going into the ECB, down about 0.2%. Christine Lagarde with some explaining to do at the ECB. There was all this talk about front-loading bond buying through this quarter. Not showing up in the data in a way that many people anticipated. Expect a lot of questions on that in tomorrow's news conference, which we will take right here on Bloomberg TV and a little bit on Bloomberg Radio too. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
About 25 minutes into the session, here's your equity market, up about 0.2% on the S&P. On the Russell, a snapback after losses amounting to north of 3% Monday, Tuesday. Wednesday, we advance about 0.5%. NASDAQ, unchanged. Netflix, the weighty move lower from Netflix, holding things back a little bit elsewhere. Let's get you the trading diary, what you need to be watching this week. President Biden discussing the current state of vaccinations today, 1 p.m. Eastern Time. Tomorrow, an ECB rate decision and Christine Lagarde news conference coming up on Thursday morning. Looking forward to that. Look out for existing home sales and initial jobless claims in the United States as well. And rounding out the week on Friday, the CDC advisory group meeting to discuss the J&J COVID vaccine. Will those shots resume in the United States of America? From New York City this morning, good morning to you all. This was the Countdown to the Open. We'll be with you with the news conference from the ECB and President Christine Lagarde tomorrow. I'll pick up shortly after that and run you through the events of the morning. Looking forward to doing that. Catch me on Twitter for more, @FerroTV. This was the Countdown to the Open. This is Bloomberg TV.